Okay, check the answer to homework question. In NR taxation, there were 4 questions in homework. First is question number 5. Check the answer to question 5. This question was based on conversion benefit applicable for NR. See, first let me show you the theory of conversion benefit. See, there was one section in capital gains, which I had explained in capital gains, which is called first proviso to section 48. Here you know, if these 4 conditions are satisfied, first you calculate capital gains in foreign currency and then you convert into Indian currency. Okay. And what were the 4 conditions? Non-resident should be the assessee, shares and debentures should be of Indian company, acquired in foreign currency, and it should not fall under 112A. Means STD paid scenario, it should not fit in. It means 112A means long term with STD paid. It should not be like that. So if all these 4 conditions are satisfied, then we follow this approach. That first you will calculate in foreign currency, then convert into Indian currency. And if you see our homework question, these conditions were satisfied. See, read. In the question, what was given? Ryan Gomez, a non-resident, okay, sent $50,000 to India on 4th June 2011, which was utilized to purchase shares of Indian company. Check the condition. See, the conditions are like this. Assessee should be non-resident. So check. Ryan Gomez is a non-resident. Then see the second condition. Shares and debentures should be of Indian company. Check here. It is shares of Indian company. Then what was the third condition? Acquired in foreign currency. Here also it was given. They have sent foreign currency to India to purchase. So it is acquired in foreign currency. But what is the fourth condition? It should not fall in 112A. So check that. In the question, they have given 2 scenarios. Under situation 1, what they are saying? Shares are purchased and sold through RSC. If purchase and sale happens through RSC, so you have to pay STD. And this question is of long-term gain. See, we purchased the shares on in 2011, we sold in 2025. And it is by paying STD. And long-term capital gain by paying STD will fall in 112A. And what is the condition? You should not fall in 112A. See, this is important. Many times this point has been tested. You know what they will do? They will create the atmosphere of conversion benefit by giving buying rate, selling rate, etc. And generally student gets carried away. But sometimes they fool you. So that's why I am minutely checking each condition. Only if these 4 conditions are satisfied, all 4, then and only then I will use the knowledge of conversion benefit. So see, in this question, first 3 conditions were fulfilled. But what is the 4th condition? You should not fall under 112A. So under situation 1, you are falling under 112A. So you will not use conversion benefit in situation 1. But question has given you 2 situations. Second situation says what? Shares were not sold through RSC. Not sold through RSC means not STD paid, and not STD paid means now you can say not falling under 112A. So that means situation 2, we will follow the rule of conversion benefit. In short, what was the purpose of the question? That you have to solve the question in 2 situations. Under situation 1, don't do conversion benefit because it is falling under 112A. And under situation 2, you have to do as per conversion benefit. Okay. And when you have to do conversion benefit, you will need buying rate and selling rate. But if you remember, when I had explained in capital gains, how do we do the conversion? Based on the buying rate, selling rate or average rate. We will do as per the average rate. But after the capital gains is computed, final conversion into rupees, that happens according to the buying rate on transfer date. This was a protocol which I explained in capital gains. I hope you remember. So first conversion will be according to average rate, but after the capital gains is computed, when you reconvert into Indian rupees, it will happen according to buying rate. Okay. But see, this I will do in second situation. First situation, tell me how will I solve? First situation, I will not do conversion benefit, means I will calculate capital gains in plain rupees terms. And it will be according to 112A. And you know what is special in 112A? In the capital gain, sometimes the cost is plain cost, sometimes grandfathered cost. Sometimes plain cost, sometimes grandfathered cost. That depends upon whether you're old investor or new investor. What is the meaning of old investor? Try to recall capital gain. If invested on or before 31st Jan 2018, you are called old investor. An old investor will get grandfathering. So here, Ryan Gomez has invested in shares in 2011, which is before 31st Jan 2018. So old investor. So you will do grandfathering. And after doing grandfathering, the capital gain which you get from that 1,25,000 exempt, balance is subject to 12.5% tax. See, whenever you come to know it is STD paid situation, two things you should always be reminded of. One is doing the grandfathering in the cost, and other is 1,25,000 on exemption. But grandfathering you will do only if you are an old investor. So that you should check. An old investor means invested on or before 31st Jan 18. So here Ryan Gomez is old investor. So we will do grandfathering. And for grandfathering they are given this FMV also. How do you find grandfather cost? FMV compare with the sale price, whichever is lower, and then compare with actual cost, whichever is higher. That is a value formula for grandfather cost. So see, in the first part of the solution where STD is paid, we will solve according to 112A. See why I am saying 112A and why not 111A? 111A is if STD paid short term is there, but here STD paid long term is there. So see, selling price I have written as it is, but cost is the plain cost or grandfathered cost. It is grandfathered cost. And see how I have done the grandfathering. FMV, sale price, whichever is low, compare with actual cost, whichever is higher. So this 36 is called grandfathered cost of acquisition. And then after subtracting, you get long-term capital gain. Now tell me, from this long-term, how much is exempt? 1,25,000. Balance is subject to 12.5% tax. But this knowledge you should show if the question is on tax calculation. Here what they've asked, compute the capital gains, that's it. So no need to show off the knowledge of 1,25,000 because that 1,25,000 exemption is while calculating tax. Question doesn't say to calculate tax. So your answer will be this plain 1,80,000. Then under the second situation, you are not paid STD, and not paid STD means you are satisfying this condition or not falling under 112A. So you will use conversion benefit, and in conversion benefit first computation will be done in foreign currency. Okay, so foreign currency, first you will take the FVOC sale price. What is the sale price? It is rupees 45 per share, rupees, but you cannot write in rupees, you have to convert in foreign currency. But what rate you will take for that? Buying rate, selling rate or average rate? You will take average rate. And in this question average rate is what? Average rate is 34 and 60. 34 is on purchase date, 60 is on transfer date. But to convert sale price, transfer date is important. So we will convert according to $1 60 rupees, $1 60 rupees. Okay. So see I have done here. According to $1 60, it comes to $15,000. How did I get? Actual selling price is 20,000 shares into 45 rupees. This is rupees. Okay. And 60 rupees makes $1. So these many rupees will make how many dollars? It's by cross multiplication. So your sale price is coming to $15,000. Okay. But that conversion is according to $1 60. This is the average rate. Then cost of acquisition you will convert according to average rate on the date of purchase. On date of purchase, what is the average rate? $1 34 rupees. Okay. And what is the cost price? Cost is 17 per share into 20,000 shares. But this is in rupees. Okay. So if 34 rupees will make $1, so these many rupees will make how many dollars? So by cross multiplication. So that comes to $10,000. So your capital gain is $5,000 in foreign currency. Now this you have to convert back into Indian rupees according to buying rate. See, this I had explained. This nothing is new in this sum. This we had already studied in capital gains. And if you remember, I told you final conversion is according to buying rate. And that also on transfer date. So on transfer date, the buying rate is $1.59. So convert according to $1.59. So for $5,000 into 59 will be 2,95,000. So this is capital gain under second situation. Okay. So finally we got two answers. Under first situation your long term gain is 1,80,000 and under second situation your long term gain is 2,95,000. But under second situation STT is not paid, na? So full 12.5% tax will come. But under situation 1, the answer is subject to STT paid. So you will get exemption of 1,25,000 and on balance 12.5% tax. But that knowledge you show only if the question is on tax calculation. See, this types of question has been frequently asked in past paper. Trust me, this theory is most important. Okay. Then we had question number 6 in homework. This question was on presumptive taxation for shipping business under section 44B. Okay. Under 44B, you know, there was a rule that if a non-resident carries on shipping business in India, so whatever gross receipts he is making from India, 7.5% he has to show as PGBP. So see, in this question, there is one person, Mr. Robert, he is a non-resident, he is operating ship. See, what is asked at the end? Compute his total income. Okay. And also calculate the tax liability. See, you have to calculate total income, means all 5 heads. Then calculate the tax also. Assuming he is shifted out of default regime. You know what is default regime? New regime. New regime is called default regime. And you are shifting out of new means you are going as per old regime. Okay. See, for PGBP you will follow presumptive tax calculation. But all other heads of income you will write as usual. And see why I am worried about all other heads? Because question is on total income. So you will have to write all heads of income. But in that all heads of income PGBP will be calculated presumptively. And then you have to also calculate the tax. So first, mainly the question is on PGBP of shipping business. See, they have given these points for calculation of PGBP according to 7.5% rate. See what is given. First point, received 200 lakhs in India on account of carriage of livestock from Mumbai to London. Means ship has started from Mumbai and it has gone to London and it has carried out what? Livestock in that. And what is the collection for that? 200 lakhs. Tell me, in every point, you know what you have to check? Either it should be accrued in India or it should be received in India or both in India. But if by chance, if you remember, I told you in last lecture, if it accrues also outside India, received also outside India, then we don't take it in 7.5 calculation, 7.5%. So tell me, in first point, where it is accrued and where it is received. Received, it is clearly mentioned, received in India. How will you come to know accrued? See, if you remember in my last lecture, how did I explain that if bookings are done in India, it becomes accrued in India? You know, this was the example which I gave. So in my example, I communicated so smoothly that booking was done in India. So you understood accrued in India. But here they have not given where the booking was done. So you know what is the trick? If the ship is starting from Mumbai, see, you have to see the start point. Tell me, this journey has started from London or from Mumbai? From Mumbai. See, I have highlighted from Mumbai. That means accrued in India. See, either they will give you where the freight was booked. If freight booking place is given, then it is simple to identify, just the way I explained. That if booking happens in India, income is accrued in India. See, basically I am trying to figure out what income should be either accrued or received in India or both in India. Because if income is accrued also outside, received also outside, we don't consider that, na? So how to figure out the accrual? See, where it is received, it will always be specified. That is never a problem. Problem with the student is, they are not able to figure out where it has accrued. And if they give, it was booked in India, then you can understand also. But in this question, if you notice, they have not said where the freight was booked. But once they say the ship started the journey from Mumbai. From Mumbai means accrued in India. So you have to see the start point, not the final destination. Okay. So if the start point is from India, accrued in India. So you can also highlight, look, in your, see, you might be wondering, sir, why you are worrying so much? Already they have said it's received in India. I know, received in India means it's an Indian income only. To call something Indian, what are the two things? Either accrued or received. So from received angle, it is clearly given India. But then as a student, you should know, na, what is the place of accrual. So do one thing, give importance to this, and you can write, therefore, accrued in India. Because the ship is starting from Mumbai. That from thing is important, start point. Because I remember when this type of question came in one past paper, immediately after exam, few students asked me the doubt, sir, how will we come to this is accrued in India or not? So I had to tell them that once the ship is moving from India, it's accrued in India. And if the ship starts from London, then accrued in London. So tell me, first point is what? Accrued in India as well as received in India. So definitely you will take it. So see, I have put a tick mark here. Tick mark means I will consider this. Then what is the second point? Received 50 lakhs in India. So received is in India. And technically once received in India, just move fast to the next point. In exam you have to rush up, na? Received in India means definitely I will take. But let's discuss properly. Tell me, it's received in India, but where it is accrued? That depends upon ship has started from which place. Don't see the final destination, see the start place. So it has started from Dubai to Colombo. Colombo is in Sri Lanka. So it is from Dubai to Sri Lanka. So it has started from Dubai, so accrued in Dubai. But it's okay. Even if accrued in Dubai, received is in India, na? So you will count in our calculation. See, what is the rule? Either it should be accrued in India or received or both in India. Then what about the third point? Third point, they are saying the 65 lakhs was received in Dubai. Means it was received outside, but accrued in India. How do I know? Because ship is starting from Chennai. See, you also highlight these from destinations, from destination. Sorry, from, not destination, from location. From which location it starts. Start point will determine the accrual. So if the ship has started from Chennai, so it's accrued in Chennai. Because obviously when the ship starts from Chennai, people will do the booking in Chennai. So accrued in Chennai. So even this I will consider because accrued in India. But see, fourth point, received in Dubai, accrued also in Dubai, because here the ship is starting from Dubai. So received also Dubai, accrued also Dubai. So this you will not count. Cross mark. Because here accrual and receiving both is happening outside. Then they have given some expenses of shipping business. You have to ignore because what is the rule? 7.5% is of gross receipt. Gross means gross. You cannot cut off the expense. It is on gross basis. So gross receipt 7.5%. So this you will ignore. They have put a cross mark. Then winnings from horse, this is altogether different income. Income from other sources. So PGBP will be based on this. voyage information. But winnings will give you income from other sources. So see, the 5 heads of income, we have PGBP and income from other sources, we have got winnings. And how did I calculate PGBP? How did I get this amount? Simple. These 3 amounts you added and you have taken 7.5% of that. 200 lakhs plus 50 lakhs plus 65 lakhs. Add all these 3 amounts, multiply by 7.5%. That comes to how much? 2360 to 500. Income from other source winning. So GTI this much, NTI this much. Okay. And then tax calculation. See, in the question they've asked tax liability also. And whenever the question says tax liability, start doing that. Satak, latak, winnings balance. Satak, latak, winnings balance. गरीबों के लिए rebate, अमीरों के लिए सरचार्ज, सबके लिए हेल्थ एंड एजुकेशन सेस. So satak, latak, winnings balance. So we don't have sataks and lataks. We have got winnings of 25 lakhs. And then balance income. On winnings 30% tax and on balance slab rate. Why slab rate? Because assessee is an individual. Okay. And for individual there is slab rate. Okay. And which slab rate? Here he has shifted out of new regime. So he has gone as per old regime. So I will apply the slab rate of old regime. And you know, in old regime I have given you one shortcut for applying slab rate. What is my shortcut? Directly multiply the income by 30%, then subtract 187,500. I hope you remember this shortcut I had given. But this shortcut is only in old regime slab rates. Whenever the income is subject to 30% slab. If you want, you can calculate in detail slab wise up to 2,50,000, 2,50,000 to 5 lakhs and so on. Then surcharge is not there because income has not crossed 50 lakhs. Why I am thinking according to 50 lakhs? Because question is on Mr. Robert, individual. Okay. No surcharge, but health and education cess will come. So this is a tax liability. Even this type of question have come frequently in past papers. Huh? Then question number 7 was there. Question 7 was for residential status. See in the question, directly read this part first. Read what was given. Determine the residential status applying the provisions of poem. So tell me here which knowledge will be useful? This knowledge. I will keep that page open for you. This knowledge. See, students who are watching the video lecture, make sure you have done the homework, then only you sit with the video. Otherwise, it's pointless watching the video. See, in question 7, what is given? ABC Limited, a software giant in India, set up 100% subsidiary by the name SHD in Switzerland. The ABC is of India, but SHD is incorporated in Switzerland. And question is testing what? Residence status of SHD. Because see, for ABC Limited, we don't have to figure out the residence status. Huh? Once you are an Indian company, you are always resident. And anyways, they are not even asking for ABC Limited. They are asking for whom? Residence status of SHD. And SHD is a company formed in Switzerland. It's a foreign company. And see, if you remember my theory, for foreign company only it is interesting to know the poem. Indian companies are always resident. So first check in the question, they have given some foreign company SHD incorporation. And then what they are saying? It is mainly engaged in software service, hardware service, data backup in 3 different countries. Means this SHD has spread the business in 3 countries. Which 3 countries? Switzerland, Sweden and India. And see the details given below. The details are given for assets in Switzerland, Sweden, India, employees in Switzerland, Sweden, India and so on. These information are useful to check which test? Active void test. Okay. So tell me how will you proceed? First in the question you have to figure out the turnover of the company. So tell me what is the turnover given in the question? Have they given the turnover? See, if their income is 80 crores, income is like net profit, income is like net profit. So definitely their turnover is some big amount only, na? The income itself is 80 CR. That means it's a clear-cut hint that turnover is much larger than the profit amount. So it's definitely more than 50 CR. See, I'm trying to show that you should strictly follow our theory. Don't go as per some, go as per our system. Some will always manipulate and confuse you, but my system will always help you. Okay. So see, the sum is in front of me, but I am not going according to the sum. My mind is going according to the system. So first I figured out, yes, it's a foreign company. Then the turnover is more than 50 CR. Next, what I will check? Active boy conditions. 4 conditions are there in active boy. So we'll check one by one. First condition says what? Your passive income should be less, active income should be more. So see, in the question they have given details breakup of the income. The total income is this much. But why they have given the breakup? To understand how much is passive income and how much is active income. So let's see, they have given 1, 2, 3, 4, 5 incomes. In that, which is passive and which is active. What is the meaning of passive income? Purchase of goods from AE and sold to AE. It is between AE only purchase and sale is happening, then passive. Interest, dividend, rent, royalty, capital gain, they are passive. So check one by one. First point is 28 crores income was derived from transactions where purchase were from AE, but sale is to non-AE. So non-AE means it becomes active income. To call it as passive, purchase and sale both should be with AE. So this is not passive, this is active income. What about second point? 24 crores is derived from transaction where both purchase and sale are with AE. And where purchase and sale both are happening with AE, it becomes a passive income. See, I have written P for passive income. Then in next point, transactions are purchase from non-AE, sale to AE. So this will become active. To call passive, purchase and sale both should happen with AE. So here I will not write P, P for passive. Then capital gain income, interest income, they are always passive. See, in capital gain and interest, AE, non-AE doesn't matter. So once it is interest, dividend, rent, royalty, capital gain, it's always passive. So these 2 points are passive income. See, I have written also P. So tell me, what is the amount of passive income? 24 crores, 8 crores, 4 crores. Please add 24, 8 and 4. Total is how much? What is the total of 24, 8 and 4? How much? 36 crores. And what is the total income? 80. So passive income is less than 50%. 50% of 80 is 40 crores, but passive income is less. So good. We cleared the first test. Passive income should be less. Okay. Then what is the second test? Assets in India should also be less. So see, assets information they have given here. See, in all, how many assets they have? 60 crores. See, assets. Switzerland, Sweden, India, total assets are how much? 60. But out of 60, how many assets are in India? See, we have to check assets in India. See, don't forget the condition. Asset in India should be less. In India. So, total assets across the world is 60 crores. And how much is in India? 24. So, which is less than 50%. Because 50% comes to 30 crores of 60. It's less than 50. So, we have passed this exam also. Which exam? This second paper. Then third criteria is number of employees should also be less in India. So see, what are the total number of employees they have got? 45,000 in Switzerland, 15,000 in Sweden, 40,000 in India. In all they have got 1 lakh employee. But it includes some unskilled employee also. This is just for confusion. Did I say anything about skilled, unskilled while I was explaining the theory? No. So go as per my system. Don't go as per some. Some will purposely give something so that you start thinking, But did I ever say like that? If something like that would have been there, I would have taught in the theory, na? So it is just for confusion. So don't get carried away. So tell me, in all, number of employees is 1 lakh. Out of which, how many are in India? 40,000. So it's less than 50%. 40,000 compared to 1 lakh is less than 50%. Huh? So even this criteria we have fulfilled, number of employees. What is the fourth criteria? Payroll expense in India. See, every year we have to see the percentage in India. Even payroll expense in India should be less. So see, payroll expense information is given here. What is the total payroll expense? 12 CR. And what is the payroll expenditure in India? 5.4. So 5.4 compared to 12, it's less than 50%. So even this test we have passed. So since we have passed all the tests, we will say active boy yes or no. Yes. Now we have to check one more thing. Huh? See, just because active boy is over doesn't mean that you are NR. If you remember, I told you just as to become a chartered accountant, you have to clear all 6 papers of CA final, plus that some formality of IT training, etc. is also there. So here they have passed the main exam, but some formality of majority board meeting is also to be verified. Huh? Only if the majority board meeting is happening outside, poem will be outside. So check where are the board meetings happening. See, in the question they have given, there are total 4 board meetings during the year. Out of which, how many meetings were held in India? 2 meetings were held in India. Out of 5 board meetings in a year, how many were in India? In India 2. So in outside India 3. So majority meetings are outside India. So from active boy angle also their business is outside. Board meeting also outside. So poem is outside. So they are NR. Status decided NR. See, are you noticing? My purpose of giving the homework is what you know. What I explain in the form of theory, it should be applied in the form of the sum. All these sums I have customized in such a manner that for every theory you should have some connected question. Now see, this question we answered, the status is NR. But they have asked one extra question here. Read this portion. Read this portion. There is one additional question. See, this question has been selected from ICAI source. Huh? Main question we answered, the status is NR. Now there is one twist. You know what they are saying? Look, they are saying that this company of Switzerland, they are getting more work in India. They are getting more work in India. But to execute the work, they need staff. They need staff in India. But problem is what? If they appoint more staff in India, what will be disturbed? Number of employees in India will change. And if this changes, our active boy condition will be affected. Okay. So, but tell me, how do I know all this? Because they have clearly said that they are getting more work in India. See, they have written, see, increased operations in India. So, getting more work in India, and to do more work in India, they will need more employee. And you know how many more employee they will need? 30,000 more employee in India they will need. Why I am saying in India? Because this increased operation is to be done in India. So they will need 30,000 more employee in India. So they have got a choice now. Either to appoint 30,000 more employee, or there is one option that not to keep the employee under our payroll. Whatever increased work we are getting, outsource it. See, bottom line is what? They are getting some more work in India. So they have one option to outsource that excess work to outside agency. But outside agency also, to execute the work, they will also need staff, na? But they will be able to do extra work with 15,000 employees only. See, if we have to handle that extra work, we will need 30,000 more employees in our payroll. But what is the other option? Accept the work, because see, no company will reject any work coming in a business. So second option is what, accept the work, but don't do it yourself. Outsource it to some agency. But when agency does the work, they can do that extra work with the help of only 15,000 employee. So tell me how it will affect, if we do the work, our number of employees will be increasing by 30,000. But if it is outsourced, there will be only 15,000 increase in the number of employees. And in outsourcing option, actually the employee will be in the payroll of that outside agency. But still, the work is ours. They are counted as our employee only. This point was important. Student thinks what? That once we outsource the work to the outside agency, they will keep the employee under their payroll. Although they are keeping the employee, but for executing our work, and for our work, whether the employees are working under our payroll or agency's payroll is irrelevant. After all, employees are working for our work. Only thing is our work done by ourselves. We will need 30,000 staff. But our work handled by agency, it can be done with 15,000. So in short, we have got two options. Look here. What are the two options? Option 1, take all 30,000 employees under our payroll and execute the work on our own. Second option, give it to external agency, and external agency will do our work with the help of only 15,000 employees. See, I hope you understand this. This 15,000 employee, although they will be in the payroll of external agency, but they will be called my employee. Because after all, these employees of external agency, they are doing the work for our company only. So see, under both the options, number of employees will change. And tell me, once the number of employees change, look, this condition will get disturbed. And in our question, all the extra employees will be recruited in India only, because that extra work we are getting in India. So tell me, originally, look here, in the original question, how many employees were there in India? Check. In the original question, we already have 40,000 employees in India. So what will be the change now? Under option 1, we will have 70,000 employees. And under option 2, we will have 55,000 employees. Only thing is, under option 2, they will be under the payroll of external agency, but still they are called our employee, because after all, external agency is executing our work only. Okay. So 40,000, which was the original number of employees in India, will change to 70,000 in option 1, 55,000 in option 2. So let's figure out what difference it makes. See, can you see the change which I highlighted here? Everything else remains same in the question. What has changed? Number of employee in India, which was originally given 40,000 in the sum, here it will be 70, and here which was given 40, it has become 55. So tell me, where is the percentage affected? Here number of employees in India is 70,000 out of 1,30,000. So percentage is 53.85. And under second option, number of employee 55, and out of total employee 1,15,000, percentage is 47.83. So tell me, which option is better? Option 2 is better, because here your number of employee in India is remaining below 50. Tell me why I am happy below 50? Because below 50 means less than 50. It will help me in satisfying the active void test. And we love active void test satisfied. Why? Because when we satisfy that, we will get the status of NR. If you remember last lecture, I told you what is the preference of a foreign company. They would prefer to become R or NR. NR. Because if they become R, they will have to pay tax in India for the world income. Okay. So they will prefer which status? NR. But for that, they should satisfy active boy. And for active boy, number of employees in India should be less than 50%. And that less than 50% is happening only in option 2. Option 2 is better. Option 1 will change the whole game. In option 1, number of employees in India will increase beyond 50%. So we will fail in active boy. So that is not advisable. So which is the better option for the company? Go for option 2. See, these plannings in real life foreign companies do. See, in real life, all the foreign companies, they make sure that this condition doesn't get disturbed. Because every foreign company prefers to remain NR in India. So they have to do all this planning, okay? So tell me, what will you advise to the company? That if you want the status of NR only in India, option 2 is better. Because under option 2, your number of employees in India is still remaining below 50%, which will keep your active boy test satisfied. Okay. So this was a good question. This is from ICAI only. Okay. Then one more question was there. Question number 13. Read this sum. This question was on FII. Those who have done the homework might have read it. The question is on FII. I'll do one thing. I will keep this theory open for you. Tell me, FII means section 115 AD. But 115 AD means it talks only about security oriented income. Huh? But if by chance FI has got some income from sale of land, etc., then general provisions will apply. Special provision applies when securities incomes are there. And I also told you in one lecture, think out of the box. Means just because it is FI, don't think in a closed environment like this. FI can also be called as a foreign company. And if anything from 115A is applicable and it is beneficial, why will we not use that? So here also in this question, this thing has happened. Huh? See here. Basically, big incorporations and FII are also foreign company. And once foreign company, you can also take advantage of 115A plus you being FII, 115AD is anyways applicable. Now see in the question what they've asked, read the last line. Compute the total income and tax liability. See, obviously they will ask tax liability because these sections are useful for calculating tax. Question has to be on tax liability. Now see what are the incomes given in the question. This is a question from past paper and it has repeatedly come. A similar thing was asked in September 25 paper also. This is ICI question only but not asked once, repeatedly asked. See what is the first point, read. Interest on investment in rupee denominated bonds of an Indian company, investment made in 21-22. See, if you just think from 115 AD point of view, what will you feel? Interest and dividend 20% tax. See, interest and dividend, isn't it? But this is as per 115 AD. Here I am able to use 115A. I'll tell you how 115A becomes applicable. Look here. 115A is for a foreign company. And see, we are fitting in this situation. How will you know? See, if you are wondering, sir, how will we know? You will know only if you revise properly, na? If all these things are by-hearted properly, definitely it will strike you also, just the way it strikes me. So see, in the question there is rupee denominated bonds. So let's check rupee denominated bonds. And then check one more thing. Investment was done when? in 21-22. So investment date is between 1/7/12 to 30th June 23. Okay. And approved by government is not given. So we'll assume approved by government. So these conditions are clearly satisfied. So tax will be as per 5% rate. And under which section I will call this as 115A. So see what I have written here. Read what I have written. 115A, 5% tax. Okay. What if the investment was made after 30th June 23? What if the investment was not between this date, it was after 30th June 23? Then this will not apply. And if this doesn't apply, then rate will be 20%. See, 4 and 9 you will apply when? If the rupee denominated bonds are listed in IFSC stock exchange. That they should say, na? If they don't say, don't even think of 4 and 9. 5, if not 5, then 20. But here 5 because the investment date is falling between 1/7/12 and 30th June 23. Then what about dividend from Indian company? The dividend from Indian company in this section of FII, there is a rule, interest dividend taxable at 20%. See, some students told me, sir, can't we use 115A? Yes, 115 is for foreign company. FII is a foreign company. But even in 115A, tax rate on dividend is 20% only, na? So it is not a better thing there, na? If by chance 115A would have given a better thing, FII can choose the one which is better. See, whenever an entity qualifies under multiple section, you can choose the one which is better. But for dividend, whether you follow 115A or the main section of FI, 115AD, it's 20% only, na? So we'll stick to our home section. Home section means 115AD. For FI, the home section is 115AD, 20%. See what I have written here. Read. Wait. One more point is there. This 115AD, 20% is clear. Then interest on securities. Again, interest on security, if you use this section of FII, interest on securities is subject to 20% tax. 20%. What about expenses? See, there was one common point I told you. In whole chapter 12 and chapter 12A, deductions are not allowed. Except in royalty FTs where you can get chapter 6A. So expense deduction, you will ignore expenses. Okay. Then sale of securities and shares is given. The moment you see sale of security, look what you should be reminded of. FIIs, Latak G and Satak G should be reminded of. Because sale of security will create either long term or short term. Tell me what is the rule first, tell me in FII. If there is long term gain, 12.5% tax. And what do you mean by this asterisk mark? STT paid, then 1,25,000 exemption will be allowed. Then for short term, 30% tax. And what is the meaning of asterisk? If STT paid, then 20%. So we'll have to see that whether long term provision will apply or short term, because one thing is for sure, we are FII and there is sale of securities also. See, it was given sale of securities and shares. So check one by one. Bonds of J Limited. Now I want to check what you know, is it long or short? Because accordingly I will apply the chart of FII. Na? So tell me, is it long or short? You purchased in 2018, sold in 26. So period is more than 1 year. Why did I say 1 year? Whenever any security is given, you can assume listed security 1 year. So it is long term, correct, long term. So it fits here. And what is the rate of long term? 12.5%. But will you exempt 1,25,000? 1,25,000 is for STT paid. STT comes only in equity shares. This is bonds. In bonds, there is no STT, na? So plain 12.5% tax. See, I have written here. Long term gain 12.5% and section is 115AD. What will be the amount of capital gain? Selling price minus cost price, simple. Okay. Then listed shares of E Limited. See, first I want to figure out what, look, is it long or short? And then I will see STD paid or not. Okay. So first let's figure out long or short it is. See, why I'm revolving around this only because the question is on FII. So tell me, this shares of E Limited we purchased in 24. When did we sell? 26. Period is more than 1 year. I am saying 1 year. Listed securities become long after 1 year. So 1 year, long term. So long term means we fit in this case. And now you have to keep in mind that asterisk mark. Asterisk mark says what? If STD paid, you will get 1,25,000 exemption and on balance 12.5%. So here, is it possible that you have paid STD? In the question they have written also. STD paid on purchase and sale. If not given, we can assume data because listed security, generally they are traded through stock exchange. We can assume STD paid, but here they have given also. STD is paid. So STD paid means 1,25,000 exempt and on balance 12.5%. So see, even this is long term covered by section 115AD, but 12.5% on whole long term or after subtracting 1,25,000. After subtracting 1,25,000. Then unlisted equity shares are sold. So first I will figure out is it long term or short term. So figure out it's long term or short term. It was purchased on 1st July 24, sold on 7th March 26. Period is less than 2 years. You know why did I say 2 years? You forgot capital gain, na? In capital gain, 1 year rule applies if it is listed security. Then only 1 year. Is it listed or unlisted? Unlisted. So for unlisted, the rule is not of 1 year, it is of 2 years. And see, from the date of purchase, when will 2 years expire? 30th June 26. Till 30th June 26, 2 years are still running. And we have sold the shares when? In March 26, March, which is before June 26. So sale is happening before 2 years. Short term. And short term means, see, I will be inclined to use this rule now. Short term. But now the question is, will I apply 30% or STD paid 20%? See, their asterisk mark I have made is for what? Asterisk means if STD paid then 20, otherwise 30. So here it's STD paid or non-STD paid? Non-STD paid. Because unlisted shares are not traded through stock exchange. So not STD paid and not STD paid, 30% tax will come. You will apply 30% tax. See, I have written here. Wait. This will be short-term gain, 30% tax as per 115 AD. Okay. You understood short-term because the sale is in a period within 2 years, less than 2 years. So short-term. And short-term, if STD paid, you take 20%. But this is not STD paid because unlisted. So 30% for FII. See, 30% is concessional for FII. Otherwise, FII being foreign company, they should be taxed at 35%. But 115 AD provides a concessional rate of 30%. So see, against all income, I have given the tax rate. So now what you have to simply do? First, total income is asked. So just total up all the income. See, total income is not challenging because we don't have to do computation. Yes, in capital gains, we'll have to do computation. But it is simple. Selling price minus cost price, selling price minus cost price, selling price minus cost price. So tell me, in my total income, there are 3 capital gains. There are 3 capital gains. Just count and see. 3 capital gains, correct? 3. And then, apart from 3 capital gains, 1, 2, 3 more incomes are there. So total, we have got 6 incomes in the question. Count how 6? 1, 2, 3. And inside 0.4, there are 3 capital gains. So there are 6 incomes. I will show you 6 incomes. Check here. 1, 2, 3, 4, 5, 6. See, these are the 3 capital gains, which is simple, sale price minus cost. And at the start of the sum, there were 3 more income givens. 3 more income given. So in all, we have got 6 incomes. So see, in statement of total income, nothing special I have done. I have just kept all the incomes in the list and just simply totaled up. And you know why I am interested in preparing the statement? Because I want to figure out the final total income. If the final total income exceeds 1 crore, there will be surcharge also. Why I am worried about surcharge and all? Because the question is on tax liability. You have to think about surcharge also, na? So here tell me, will surcharge come? No, because the total income is not crossing 1 CR. Foreign company, we have to check 1 CR. If this would have crossed 1 CR, then 2%. Crossed 10 CR, then 5%. But here no surcharge. And see, how many incomes were there in the question? Repeat, how many incomes were there? 1, 2, 3 and this 3 capital gains. 6 incomes were there. So see, 6 taxes. 1, 2, 3, 4, 5, 6. Just count and verify. I will not repeat the explanation because all explanation I have done. Just see the answer. You will find 1, 2, 3, 4, 5, 6 taxes. Because there are 6 incomes in the question, all having different rates. So 6 taxes are calculated. So see, in this statement we have written the 6 incomes, and in this statement we have written the 6 taxes, and the total of taxes this much. Surcharge will not come, health and agency cess will come. So your tax comes to 917,982, and you can round it up to the nearest 10. 982 can be called as 980. See, if it is 985 or something more, then I would have made 990. But here it is 82, less than 85. So it will be kept as 80 only, 980. So this was question number 13. This was a good question. Such question I have come in past paper repeatedly. So all homework questions we have discussed. Now, we were doing section 9. See, in section 9, last lecture, what did I say? This section is relevant for every assessee or NR assessees, NR. Because basically this section explains what? When income is said to accrue in India, and that information is relevant for NR. See, for resident people, what difference it makes? Wherever the income accrues, we have to pay tax on world income to government. So for resident people, it doesn't matter where the income accrues. But for NR, it does matter. Because only if the income accrues in India, NR will be taxed in India. And when it is said that income has accrued in India, it is explained in section 9. And you know, this section I had planned to explain headwise. Because we are learning income accrued in India. Income can be under 5 heads. So we were going headwise. So first I explained under the head income from salary when income is said to accrue in India. Then I had explained income from house property. Then we were into PGBP, next head of income. So this is still going on. So tell me once again, when PGBP income is said to accrue in India, if the non-resident has a permanent establishment in India, means either he should have a fixed place in India, whether it is an office, shop, branch, godown, warehouse, whatever you call, having a fixed location in India, or having a fixed agent in India, or if no place or no agent, their presence in India should be significant. Means they are doing with India transactions of more than 2 CR, or even if they don't transact with India, in India they have engaged 3 lakhs or more users. So then such NR becomes popular in India. So they have got presence in India. And nowadays having digital presence also matters. Okay. So this is kind of a digital presence, na? More than equal to 3 lakh user means what? They are having digital presence in India. So an either or means what? You don't have to satisfy all 3 criteria. Any one criteria satisfied, we say your income is accrued in India. Now, this much I had explained in the last lecture. Now see, fixed place in India is generally called P in India, but there are exceptions. If the non-resident has a fixed place in India for storage purpose, only for storage, means imagine some non-resident of Singapore, keep that in mind, this non-resident is of Singapore, means he is having a big business. In India, he has hired a place, but only for storing the goods. He is not doing selling, he is simply storing. So if you keep in India a place only for storage, so although you have a place in India, but that will not be called as P in India. You will not be taxed in India. Because see, NR will say what? I have kept a place only for storing the goods. I am not doing selling in India. I am not generating income in India. I am simply storing. And this much if you don't allow me in India, then this is bad. Countries will have bad relations. So if some foreigners, some Singaporean, Chinese or Japanese company, they have a place of storage. Storage means strictly storage. Sales should not happen from that place. Then it is exempted. Exempted means it is not treated as PE. Now, storage was just one example. This way, there is one big list. See, there is one keyword which I call it as SHIRISH. How do I pronounce SHIRISH? In SHIRISH, S stands for storage. See, excluding means you understand now, na? If the place in India is SHIRISH place, then they are excluded from the definition of PE. And if they are not called PE, it's good for them. Their income is not said to accrue in India. So what is the full form of SHIRISH? S for storage, D for display. Now imagine that Singaporean company, non-resident, in all my example I will communicate from NR point of view. This whole section which I started is relevant only for NR. So every example, imagine there is some non-resident, okay. So now imagine there is some non-resident, they have a place in India and the place is only for displaying their products. They simply display the product to Indians. Only display. Sale doesn't happen from here. Yes, if someone likes the product, sale will happen from Singapore or from foreign country. From India, they don't sell. They simply display. Even that is not a place of business in India. See, these are actually one way exemptions from PE. See, PE is a torture for them. Why torture? Because if it is proved that you have a PE in India, you have to pay tax in India. But there are some exemptions in PE. First was storage, D was display, another P is purchasing goods. Please imagine that Singaporean company has kept a place in India and that place simply purchases the goods. Means maybe in India they do some shopping, they do some purchasing, but after purchasing they don't sell in India. See, this SHIRISH means exclusively SHIRISH. Because after storing and display, you also start selling. Then you have a PE in India. Your activity should be restricted to only storage, only display, only purchasing and no selling. Then it's not a PE. See, basically what law is trying to say, sometimes you might have a place, a big area in India, but we understand that place is not for selling goods. No? It is only for storage or display or purchasing. So don't worry, Indian government will not pounce on you. Pay tax, okay. In SHIRISH there is one more P, processing. Is imagine that non-resident of Singapore, he has taken a place in India, but in this place he simply does processing. Maybe there are some experts in India in processing. So he has kept a place where processing is done, only processing. After processing, if you sell, then it becomes PE. See, all these activities should be exclusively restricted to that much only. Then, what is the next alphabet? I. Collecting information. Imagine that non-resident from Singapore, he has kept a place in India, to gather information from India. How is the choice of Indian customer? What are the preferences of Indian customer? Only information gathering. But information gathered is used abroad. They don't sell anything in India. They are simply gathering information. See, why do they gather information? Sometimes they might have future plans to set up a business in India. Right now, they have not set up. Right now, they just had a place for gathering information. Even that is not a PE. See, these are points where even if they have a place, physical location in Delhi, Chennai, Hyderabad, Bangalore, they have a place, but we will not treat it as PE. Then last point, any other activity of preparatory and auxiliary nature. Means like storage, display, if you have some other activity also, which is of similar kind, where your activity is just preparatory, you are not doing sale. What do you mean by preparatory activity? See, storing the goods, processing the goods, this is a preparation for the end goal of sale. Sale should not happen. Don't execute your end goal in India. Do preparation. If you are doing preparation in India, preparation can be storage, processing, purchasing. Preparation activity exempt from PE. See, last O was what? Any other place of preparatory activity. What do you mean by preparatory? You are just doing preparation. You are not doing the end final sale in India. So, by heart SHIRISH. Tell me the full form fast. Storage, display, purchasing, processing, collecting information in India or any other place of preparatory activity. Such places in India where you are simply doing preparation, you are not doing sale and etc. things, then it is not a PE in India. That means income will not be said to accrue in India and you don't have to pay tax. Okay. Like see, answer this in the question. If they say non-resident had a place of displaying product. Okay. Had a place of displaying product, only display. And the customer who liked the product in display, they placed an order, but sale happened from foreign. Sale didn't happen from India land. India land was used only for displaying, na? But after the display, if the customer liked the product, they had to place the order right away in Singapore. Then India will not tax them because they will say, order has come to our Singaporean shop. India, we had kept a place only for display, na? So India cannot tax you. Now see, this rule of SHIRISH activities are excluded. You know, this rule, look, is actually not given in Section 9. What is Section 9? I am explaining Section 9. I hope you know that. Okay. So, these exceptions of SHIRISH are not given in Section 9. You know, then how did I explain all this? These exemptions are given in DTA, Double Taxation Avoidance Agreement. You know, for non-resident people, double taxation avoidance agreement is also of important. It is also of relevance. You know, like why double taxation avoidance agreement talks about PE? See, when India makes agreement with foreign country, they decide when India will tax foreigners. The terms and conditions are written in DTA. See, DTA is basically an agreement. What is the full form of DTA first? Double Taxation Avoidance Agreement. Although the main purpose of the agreement is to eliminate double tax. But in this agreement, there are many terms and conditions. And you know, when India enters into agreement with Singapore, you know, they will also write the terms of when will India tax Singaporean people. And vice versa. When will Singapore tax Indians? These terms are written in DTA. So, in every DTA, SHIRISH activities are exempted. Like if you notice India and Singapore DTA, see DTA is an agreement. And if you see India, Singapore DTA, in the agreement only they have written, if Singaporean people have a place in India of SHIRISH, India will not tax them. This is actually written not in our Bare Act. It is written in DTAA. So, but right now I am explaining Section 9. Section 9 doesn't give these exceptions. So tell me, Section 9 is little strict. What Section 9 says? You have a place in India, you are gone. You will be taxed in India. It is strict. But what that non-resident of Singapore will say, see, assume in my whole example, NR is of Singapore, for communication simplicity, okay. See, Section 9 says what? You have a place in India, gone. India will tax you, India will tax you. This is dangerous for them. Now, but India-Singapore DTAA, when you read, see, DTAA is kind of an agreement like this. And in India-Singapore DTAA, you know what is written? India will tax Singaporeans for having a place of business in India, but not having SHIRISH places. So DTAA gives them exemption for SHIRISH. So what is better for them? DTAA or Section 9? Section 9 is cruel. It cruelly says what? You have a place in India, na, you will be taxed in India. So imagine that Singaporean will be hurt by Section 9. But when DTAA provisions are seen, DTAA says, don't worry Singaporean, India will not tax you for having SHIRISH place. This is favorable or not? So you know, every non-resident has a choice to be governed by our Bare Act or DTAA, whichever is beneficial. This point I wanted to convey. See, this point has started now. Many such points you will find now. Soon you will discover there are many times that for a non-resident, Bare Act means Income Tax Act 1961, speaks something else. And DTAA speaks something else. So which is important for them? Whichever is beneficial. Like in the matter of permanent establishment only, if you see, our Section 9 has a different provision. But DTAA has a different provision. And DTAA is better because it is exempting SHIRISH places in India. And if NR is exempt in India, it is good for him. Na? So he can be governed by DTAA. He can say to hell with your Section 9. We love DTAA. And we have given them option of preferring whichever is beneficial. See, right now I was cursing Section 9. Na? Why? Because Section 9 is so strict. It says what? It says what? If you have a place in India, you are gone, you will be taxed in India. But Section 9 also gives some concessions. See, what are the concessions? 4 places are exempt. DPNS. I'll tell you the full form. This Section 9 is little harsh, but it is not that cruel also. It also gives you exemption of 4 places. What are the 4 places? Display. D for display. Display of rough diamonds. If Singaporean people, they display raw diamonds in India, only for diamonds. You know, in Surat, in Gujarat, there is a big diamond zone where all diamond businessmen are located together, okay? So, if a Singaporean non-resident, he wants to display his raw diamonds in India, precisely in Surat, Gujarat, then that place of display is not set as PE. So, see, the exception is so restricted. It is only for display of raw diamonds. Whereas if you see DTAA, see, double taxation avoidance agreement says what? Singaporean people, any place or display in India, no PE. This is DTAA. But now if you see the Bare Act says Singaporean, if you have a place of displaying rough diamonds, then only you are exempted. See, I am trying to make you feel there is a contradiction in conflict in the provisions of Section 9, which is from our Bare Act, and DTAA, which is just an agreement between the countries. So tell me which to be followed in real life, whichever is beneficial. And trust my experience, in the matter of PE, DTAA is always beneficial because it provides so many exemptions. Third PO, okay. But Section 9 exempts, see, I have written also. Let me show you this thing. See. Can you see? DPNS is exemption under Section 9. SHIRISH is exemption under DATA. Exemption from what? Exemption from the PE status. Okay. And exempt from PE status means not accrued in India, not accrued in India, not taxed in India. In DPNS, D I said P, purchasing goods in India. Same point which was there in SHIRISH. Means if Singaporean people has a place in India where they simply do shopping. Shopping means purchasing, buying. They don't sell. They simply purchase. And then selling happens in their country. In India, they are doing simply purchasing. So even that is not P in India. This is the same point which was there in SHIRISH also and DPNS also. Then can you see next alphabet N? Collecting news in India. Just imagine some Singaporean news company, they want to gather only news and views in India. But the news should not be published in India. India should be a place only for collecting the news, collecting the views of Indian people. But no display of the news in India that they are doing in their country. Even that is exempted. You know, this is similar to SHIRISH I. In SHIRISH, what was I? Collecting information. But you know, that was general. Any information you gather in India, such place is not PE. If the place is meant only for gathering information. But in Section 9, the exemption is only for news companies. Only if there is some news company in Singapore and they collect news in India for publishing in foreign land, it is getting exemption. See, in D also and L also, the exemption is restricted. Like in D, DATA provides all display places exempt. But Section 9, only display of rough diamond. Then in N, DATA says any place for collecting information is exempt from PE. But Section 9 says only for news companies, if the place in India is for collecting news in India, they are exempt. Then S for place in India for shooting. Like from Singaporean company, they are producing films. Or some Hollywood company, they are producing Hollywood movies. In India, they are simply doing shooting. Film is released abroad. In India, they should not release the film. India should be a location only for shooting. So then also they are exempted. See, shooting places are also exempted in SHIRISH. Huh? You will wonder, sir, you didn't say shooting in SHIRISH, na? In SHIRISH, what is O? O, other place of preparatory activity. And in a film business, shooting is a preparation. Film releasing will happen there only, na? So shooting exemption, Section 9 has specifically given. But in DATA, it is automatically covered in SHIRISH O. Because shooting is what? It's a preparatory activity in a film business. Okay. So conclusion, tell me distinction between DATA and Section 9. First tell me, Section 9 comes from Income Tax Act 1961. And DATA is a separate agreement. And that agreement is between India and foreign country. Okay. And what is the difference? In DATA, many places are exempted. SHIRISH. And in Section 9, only DPNS places are excluded. Okay. And what was the answer if someone says, sir, then what to follow? Should we go as per Section 9 or DATA? It is a choice of NR. See, this is a topic of NR taxation. NR has to choose. If he feels Section 9 is horrible, to hell with Section 9. You can get governed by DATA. And DATA gives you more exemptions. SHIRISH place, any place of SHIRISH is exempt from PE in India. So they will not be taxed in India. Okay. Now, in the matter of fixed agent, there is no clash between the provisions of Section 9 and DATA. Because see, what if you see India, Singapore, DATA, India, Mauritius, DATA, the provisions of agency is same as in Section 9. So here at least there is no clash. But you know, when a fixed agent is called P in India, you know, there are three conditions. Look at this. DCN. See, in this single page, you know, a very big thing I have covered. You might feel there is so much to learn, but you don't value. If you see the Bare Act in study material, the same thing is given in so much detail and without any analysis. It's a mess. But in one page, I will cover everything. Huh? So see, what is DCN? No? If DCN conditions are satisfied, then only having an agent in India is called PE. So see, firstly, having an agent means, you don't have any physical place like office, shop. You have one person agent. But that agent will be called P in India when, when that agent is totally dedicated for you. Agent should be dependent agent. It should not be independent agent. Independent agent means what? They sell product for everyone. Like see, in Singapore, there is a company, ABC Limited. And if I am agent in India, my whole life is dedicated to ABC of Singapore. Then I am a dependent agent. Then only I can be regarded as PE in India. But if Shirish Vyas is an agent who sells goods for Chinese companies, London company, German company, Australian company, I sell for everyone. I am no one's close. I am no one's loyal and no one's dedicated. I am an agent. I want to earn income by selling the product for various principles. Then such people are called independent agent, and having independent agent in India is not a P in India. So what is the full form of DCN? D for dependent. Or you can also remember, you should be a dedicated agent of that NR. Like see, I am Shirish Vyas, I am agent, and my principal is in Singapore, some ABC Limited. And I only sell products of ABC. But see, it can also be like this. I am mainly selling goods of ABC. Sometimes, rarely, I sell product for some other people also. That is okay. Because in the act, what they are saying? The agent should be mainly and solely. Mainly or solely means either I am solely selling their product or mainly. Mainly means most of my sales are for my Singaporean principal. Little bit sale I might do for some other principal. That is okay. So agent should be dedicated solely or mainly for such NR. Then it is called dependent agent. See, then government of India can say, you Singaporean company, you have made Shirish Vyas as your full-time agent. So he is like a PE in India. So what happens now? He will be taxed in India for having an agent in India who is dedicated for such company. Then C stands for look. Next alphabet C. The agent in India should either conclude the contracts or play the principal role leading to conclusion of contract. Repeat. Agent in India should either conclude the contracts on behalf of NR. See, imagine my example, I am Shirish Vyas agent in India and my principal is in Singapore, ABC Limited. Okay. Now, ABC Limited has given me the authority. Shirish, don't worry. Whenever you find good customers in India, conclude the contract. Or if not concluding the contract, I am given the main role which will eventually lead to conclusion of contract. This should be my position. That means if my position is what Shirish, you just bring the leads to us. You just bring the leads to us. Then I am not PE. My role should be main role. Either I should enter into the contract with the customer, conclude the contract, or I should play the principal role which leads to conclusion of contract. Long back, what was the law? Agent should conclude the contract. This was a loophole. Earlier in the law, what was the provision? The agent should be given the authority to conclude the contract. Then only it is called PE in India. So this was a loophole. You know what cheating people used to do? What cheating they used to do? These NR people used to tell the agent, do one thing, you do everything, but don't conclude the contract. Final conclusion we will do. Because earlier in the law, what was the provision? If the agent has the authority of concluding the contract, then only it's a PE in India. And to avoid that PE status, what they used to manipulate? They used to tell the agent that you don't conclude the contract, do everything. This is earlier law. I'm just sharing, just for knowledge. Right now, what is the law? Whether the agent in India is concluding the contract or plays the principal role which leads to conclusion of contract, such agents are called PE in India. So tell me, what was the first condition? Agent should be independent agent or dependent. Dependent means totally dedicated for that NR or mainly doing work for that NR. Second, conclude the contract or play important role which leads to conclusion of contract. Third, the contracts entered by Shirish Vyas should not be in his name. It should be in the name of principal. This is a normal condition. In agency, agents do the dealing, but not in their name. They are just a middleman. They are doing in the name of principal. So this condition is very obvious. Because that is a very basic feature of agency, na? But that is given in N. N for name. N stands for what? Can you see Dhakkan? I call this a Dhakkan. Dhakkan means DCN. DCN. I pronounce it as Dhakkan. In Hindi, Dhakkan means Dhakkan. So DCN. So N stands for what? The contracts done by agent are not in his name. They should be in the name of principal. So tell me, what are the three conditions to call agent as PE? The agent should be a general independent agent working for everyone or dependent agent. Dependent agent. C for the agent in India should either conclude the contract or play the principal role which leads to conclusion of contract. N, the agent should do the dealing not in his name, in the name of principal. Okay. If these three conditions are satisfied, then Government of India says you have a PE in India. Although you don't have a physical place, but having such Dhakkan agent is also a PE in India. And here there is no clash in DATA and Section 9. Whether you see the Bare Act or you see DATA, the provisions of agency PE are same. This I have already explained. Okay, now tell me, distinction between Section 9 and DATA in the matter of PGBB income. See, we are doing PGBB income. It is only for people having NR people having PGBB income in India. See, basically what are we deciding? If a non-resident has PGBB income in India, when will India tax them? So tell me, when will India tax them? So according to Section 9, if they have a business connection in India, they will be taxed. But DATA uses the word if they have a PE in India. See, I am trying to differentiate between the provisions of Section 9 and DATA. Both provisions are talking about what? When to tax NR for PGBP. Okay. But there is difference in the provision Section 9 and DATA, and whenever there is difference, you can choose the one which is favorable to the assessee. So tell me, what does Section 9 say? See, if you see Section 9 in the Bare Act, they don't use the word permanent establishment. Nowhere in the Act you will find permanent establishment, because Section 9 repeatedly says if NR has a business connection in India, he will be taxed. You know, here only you can feel the intention of Section 9. Section 9 is very rude. You know, it is very smart. It says if you have some business connection is a general word. PE becomes a very limited establishment. But Section 9 is horrible. They don't want to leave NR. You know what Section 9 says? NRs, Singaporeans, Chinese, Japanese people, if you have any business connection in India, you will be taxed. And what is business connection? They have not explained in detail. They have kept it vague. But DATA is very clear. It says Singaporean, Japanese, Chinese. Only if you have a PE in India, you will be taxed, and PE is properly defined also. So this is the first difference. And second difference, look. According to Section 9, if you have a fixed place in India, it's a business connection in India. The same thing is there in data. If you have a fixed place in India, it is a P in India. In having a fixed place will make you tax in India. That is a common point in Section 9 and data. Then see the difference. Section 9 says fixed place excluding DPNS. This place, see this place point, place. In Section 9, which places are exempted? DPNS. But in data, few places are excluded or many, SHIRISH. The list is long, so many exemptions are given. So since this provides many exemptions, people generally prefer data. Then next next distinction, agency P definition same. Here I have not highlighted as a distinction. This is a common point. Having a fixed agent is a P in India. It is a common point in Section 9 and data. Only thing Section 9, what is the language you know? Having a fixed agent in India is a business connection in India. But what is the language of data? Having a fixed agent is a P in India. Language is different, but the provisions of agency P is same. Then significant economic presence in India is also P in India. This torture is only in Section 9. But you know, in data, there is no concept of significant economic presence. Can you see this fixed place, agent, SCP? This was the structure of my chart. See, fixed place, agent, SCP. You know, I told you in the last lecture that if non-resident has significant economic presence in India, that is also said to P in India, but that is there only in Section 9. In data, there is nothing like significant economic presence in India. So tell me, if some Japanese company, they have got many YouTube subscribers and Instagram followers in India, more than equal to 3 lakhs. So tell me what will be their position. If a Japanese or some Singaporean company, they have got many followers and users in India, many means more than equal to 3 lakhs. So according to Section 9, you will be taxed in India. You will be taxed in India because you have a presence in India. But according to Section 9, but data says, don't worry, no tax. So what is better? Data. So they prefer data. So in short, see, by giving distinction, I meant to say, data has got better provision. Tell me what are the good things in data? First good thing is, many places in India are exempt from PA. And significant economic presence is not treated as PA. These are the main attractions. Okay. Then we are doing Section 9. In Section 9, my plan was to go headwise. Tell me out of the 5 heads, which head we did? Income from salary, income from house property. We also did PGBP. What is the next head? Capital gain. Even in capital gain, one good point will come. Huh? See, basically in capital gain, what I have to explain? For NR, when capital gain will be said to accrue in India? You only tell me. Okay, answer. For NR, when capital gain will be said to accrue in India? Accrual of capital gain depends upon what? The location of the asset. You know, capital gain comes from the capital asset. Only assets generate capital gain, correct? So location of asset matters. So tell me, if a non-resident has a land in India, so sale of such land, capital gain has accrued in India. But if his land is in Australia, so capital gain accrued outside India. So this is normal or not? So see, for capital gain, basic rule is simple, that if the asset is, asset means which asset? The asset which has generated capital gain. If that asset is in India, then income is said to accrue in India. And accrued India means NR will have to pay tax in India, okay? But this is a general rule. Here, there is one good exception. Okay, wait. Right now, what did I say? If asset is located in India, location, how do you come to know the location? Like land, we have to see physically where it is. Houses, we have to see physically where it is. Gold, again physically where it is. If the gold is kept in Delhi, Chennai, Mumbai, means location is a physical location, na? But for some assets, physical location becomes difficult, like debentures, bonds. Tell me, how will you decide debentures, bonds are located in India? Because capital gains comes from shares, debentures, bonds also, na? So your company matters. If the shares, debentures, bonds are of Indian company located in India. See, I hope you understand my feeling, what I am trying to say. See, some assets, we can see their physical location, like land, gold, houses. If they are physically seen in India, capital gain accrued in India. But what about shares, debentures, bonds, securities? They don't have physical existence, huh? So we have to see the company. So tell me, if a NR sells bonds of Indian company, asset located in India. If he sells bonds of German company bonds located outside India, so capital gains accrued outside India. In short, when you think about the location, it is generally the physical location, but for securities, location depends upon the company of which the securities. If it is Indian company security, then located in India. Okay, so answer this question now. Try this. This is some interesting case which I have hidden here. Tell me, think and answer properly. Please visualize what I am saying. Imagine some Singaporean guy. He is a non-resident staying in Singapore. He has sold some shares of German company. Shares of company in Germany. Shares of German company. So what is your answer? Is it accrued in India or not? Right now, what did I say? For items like shares, debentures, bonds, we have to see the company, na? So now what example I said? Non-resident of Singapore, he has sold shares of German company. So what will you think? Okay, shares are of company in Germany. So assets located in Germany. So that means he has made capital gains in Germany. And Germany means accrued not in India, so not taxed in India, correct? Correct? But there is one exception here. Look, imagine non-resident has got shares of German company, but in the balance sheet of German company, visualize the balance sheet, in the balance sheet of that German company of which shares are held by NR, in the balance sheet of German company, more than 50% assets are located in India. More than 50% assets are located in India. Which assets? Assets in the balance sheet of German company. I am talking about which German company? The company whose shares our NR is holding. My NR is in Singapore. Huh? Keep that example in mind. So shares are of German company. But when you peep inside the balance sheet, you know what you see? More than 50% assets of that German company are located in India. So what difference it makes? See, if German company is having most of the assets in India, so it is a so-called German company. Just because they are incorporated in Germany, they are having the tag of German company. A company does business with assets. If majority of that German company's assets are lying in India, means their factories, their machines are all in India. More than 50% of their assets are in India. So, you know, assets only derive the value in shares. Tell me, why you make capital gain from shares? Because shares gain value, and shares gain value because of assets. Tell me, if German company's balance sheet assets are bullshit assets, useless assets, then shares will have zero value. But if German company's balance sheet have got good value of asset, good value, shares will automatically derive more value. See, share valuation idea you have, na? A company share valuation depends upon their balance sheet. So imagine that German company's balance sheet, most of the assets are lying in India. So, and those assets are creating share valuation. So that means capital gain from sale of such shares has accrued in India. What condition? In the balance sheet of German company, more than 50% assets should be lying in India, but that is in percentage terms. In value terms, it should be more than 10 crores. Assets in India, in value terms, it should be more than 10 CR. Because see, sometimes, we say that they have got most of the assets in India, but in value terms, it is hardly 2-3 crores. Then, it's a German share, capital gain accrued in Germany. See what I said right now. Read. Same example, look. What was my example? Non-resident of Singapore is selling shares of German company. See, apparently it looks what? That person who is selling the shares is of Singapore. Shares are also of German company. Indian company has got no right to tax. It looks like that, na? But Indian government can tax such capital gains also. And they have got right to tax because capital gains is out of shares. Shares of the German company. And that German company has got most of the assets in India, and in value terms they are more than 10 CR. So that means it is just a so-called German company for namesake. Basically we can say it's kind of an Indian company. An Indian company shares you sell, capital gain accrues in India, na? So this was one interesting point. But here didn't you see, government is thinking so deeply. See, if government thinks from surface level, from the peripheries, it looks what? German company, capital gains accrued in Germany. But government is peeping inside the balance sheet, na? But that deep thinking government will do if more than 5% shareholder sells the shares. There is one more condition. In my example, who was a shareholder? Singaporean guy. Some Singaporean guy was a shareholder. He should be holding more than 5% shares of such German company. Means he should be some major shareholder. Then government will apply major thinking. That means if that Singaporean shareholder has got only few shares of German company, then we will not apply that major thinking. Then what we will think? It's a German company. Shares of German company are sold, capital gains accrued in Germany. Then we don't think in deep. So tell me, what are the conditions eventually you have to by heart? Answer one by one. The best is, this scene you memorize. There is a guy in Singapore. He has got shares in German company. How many shares? More than 5% of that company's share capital. Huh? More than 5% he is holding. Means he is not a minor shareholder. He is having good amount of shares. So imagine, he should have more than 5% shares of some German company. German is my example. Take any foreign company for that matter. But to memorize, it's better to imagine German company. And then, first condition, more than 5% shareholder. Second condition, inside the balance sheet of that German company, Indian assets should be more than 10 crore in terms of market value, not book value. Don't see the book value of the asset. Market value of the assets. Indian asset means what? Assets which are located in India, like factories in India, machines in India. In terms of market value, it is more than 10 crores. And in terms of percentage, greater than equal to 50%. It's greater than or equal to sign is also there. Please note that. Tell me here, is it greater than equal to 50% in my example? Total assets in the balance sheet is 25 CR. And in 25 CR, how many are in India? 15. So convert this into a percentage. It is definitely more than equal to 50%. And both these conditions satisfied. Plus the third condition, shareholder should be more than 5%. Then capital gains is accrued in India. So this was a great point. See why start? Because this is unusual. Huh? In one exam, how they fooled the students. See, they created same situation. There is one shareholder in Singapore. He is having shares of German company. but from that shares he earned dividend income. He didn't generate capital gain, he generated dividend income, and everything else was given. In the balance sheet of German company, Indian assets are more than 10 CR, it's more than equal to 50% of the total asset, everything was given. But in that question, shareholder of Singapore generated dividend income. For dividend income, this rule doesn't apply. It is only for capital gain. Because shares capital gain depends upon assets valuation. And there only assets location in India matters. So tell me, if in the same situation, if they say that shareholder has got dividend from such a German company, then dividend from German company, dividend accrued outside India. It is only for capital gain, this special point is there, keep in mind. Huh? Now, tell me, in balance sheet what we check? Answer. We see the market value of the assets in India, it should be greater than 10 CR, and we see the proportion also greater than equal to 50%. But that depends upon the balance sheet, na? Balance sheet of which date? Which date balance sheet you will see? Which date? So see, I'll give you one example. Imagine this Mr. X is our Singaporean shareholder, is NR. See, this whole theory I am discussing from NR only. Huh? Keep that same example in mind. Our shareholder was in Singapore. Assume he was Mr. X and he was having 8% shareholding. He has sold the shares of foreign company, say German company, and date of sale is 12th July. I mean, this is the transfer date. So now we want to see this condition. See, more than 5% condition is fulfilled. Now I want to check this 10 crores and more than 50%. That depends upon the balance sheet. But balance sheet should be of which date? I have sold the shares on 12th July. So just preceding the transfer date, what was the last accounting year? 12th July 25 was the date of sale of shares. Immediate preceding financial year ending is what? 31st March 25. So see, I will see balance sheet of 31st March 25. Now check the condition. Check. This is balance sheet of that German company. Take that same example. Did you see the balance sheet is of which date? Preceding accounting year. Preceding accounting year. Okay. Indian assets book value 12 crores. Foreign assets 8 crores, total 20. But will you measure in terms of book value or FMV? FMV. See here I told you it is in terms of FMV. So tell me in terms of FMV what is the value of Indian asset? 9 crore. Here only I failed. If you check the percentage also, 9 crores is how much percent of 20 crores? It is less than 50. Means both the conditions are failing. But you know there is one rule. Sometimes you will see the balance sheet on transfer date. General rule is to see the balance sheet of preceding financial year, preceding accounting year. But sometimes we have to prepare the balance sheet of 12th July. You know when? Look here. See, I have prepared here one more balance sheet. Look at one more balance sheet. This is balance sheet on 12th July. This is the exact date when that Singaporean guy sold his shares which generated capital gains. 12th July. Can you see the date? Now, see this balance sheet. In this balance sheet, conditions are getting satisfied. Tell me, as the date changes, the valuation will change, no? See, I want you to notice this was preceding accounting year and this is the exact date when shares was sold. Now tell me, here conditions are fulfilled. Indian assets market value 18 crores, more than 10 CR. And in terms of percentage, it is how much percentage of 30 crores? 60%. So see, conditions are satisfied. 18 is more than 10 crores and 18 is greater than 50% of total assets. Condition satisfied. So now there is a confusion. Which balance sheet should be seen? Because if you see this balance sheet, conditions are not satisfied. Means capital gain cannot be said to accrue in India. But according to this balance sheet, capital gains accrues in India. So see, actually we don't have a choice. Law says we will see this balance sheet only preceding accounting year. But if between the two balance sheet, if the figures substantially change by more than 15%, then we will see the right hand side balance sheet. Means you have to see the total assets book value. If the change in total assets book value by more than 15%, tell me what is 15% or 20 crores? Calculate 15% or 20 crores is 3 crores. And see the growth in balance sheet. Is it more than 3 crores or not? It has become 25. Then government says to hell with this balance sheet. We will see this balance sheet. Yes, if the asset value did not change much, if the asset, which assets I am talking about, market value or book value? Book value, see this figure. If between these two figures there is no substantial change, then we don't see this balance sheet. See, first preference is this only, na? But you know, sometimes people manipulate. Like see, this Singaporean guy may be wanting not to pay tax in India. He wants its capital gains should be said to accrue in Germany. Maybe in Germany there are no taxes. So he might be doing planning also. And since in that German company he has got good stake, he can control that German company also, na? So sometimes people do manipulate. That's why, you know, what law says, we are not a fool. Listen to the rule. If balance sheet total assets have changed drastically means more than 15% increase has happened, then we will see this new balance sheet. So see, there is one more criteria here. In short, see, just by head like this, two balance sheets are there. One balance sheet is of preceding accounting year, and other is exactly on the date when shares are sold by the non-resident. Okay. And then first priority should be given to which balance sheet? Preceding accounting year. But then you will just check what the total assets in terms of book value. In terms of book value, if the growth in the total assets between the two balance sheet is greater than 15%, by had 15%, then you will take which balance sheet? This balance sheet. Tell me, if the total of this right hand side balance sheet was only 21 CR, then the increase is from 20 to 21, not a substantial change. Then ignore this. Then stick to this balance sheet, and according to the balance sheet on my left hand side, the capital gains is not accruing in India because conditions are not fulfilled. So finally, in my example, what is happening? Assets have substantially changed by more than 15%. So I will ignore this. I'll do one thing. I'll strike this thing off. I will ignore this balance sheet and I will go as per which balance sheet? As per balance sheet as on transfer date. So tell me now, what is the rule then? Finally, what to do? Indian government will tell that Singaporean, you Singaporean, although you have sold shares of German company, India will tax you. Because such sale of German company share is deemed to accrue or arise in India, and India will tax. But India will tax what? Capital gain, but not full capital gain, 60% only. India has got right to tax only 60% capital gain. See why India is exercising right? Why? Tell me why India is getting excited? Although it's a German company, but see the balance sheet. Most of their assets are lying in India. So India has got right. But most of the asset means how many assets? 60%. So India can exercise 60% right. So see what will happen? This shareholder will calculate capital gain. See these are random numbers. Huh? Assume shares are sold for 50 lakhs. Cost is 10 lakhs. So total capital gains is 40 lakhs. But India does not have right to tax full capital gain. How much India will tax? 60%. And India will tax because according to this balance sheet, the conditions are fulfilled. See, this is one important point. Huh? And see, this detailed explanation is missing in my printed notes. Okay. See, actually in my printed notes, all these provisions you will find. But, suddenly I started the explanation of which balance sheet should be seen. And then this detailed explanation started. This is not there in my printed book because generally it is not asked in paper. I felt for safety it's better to teach. So you should make a note of this because this thing which I am showing on the screen is missing in the printed book. So you will have to write separately. You know why I give? Because in one mock test paper ICI had tested this point. Mock test. And generally mock test papers are set tougher. Main ICI paper, they have never tested this point in the main exam paper. But in one mock test paper, they had given. And generally ICI mock test papers are set on a tougher side only. So I felt that who knows, suddenly in your main exam this point comes. So for safety I have taught you. Tell me if this point comes, how will they test you? They will give you some shareholder of Singapore, some foreign country, NR. And they will say he is a shareholder having more than 5%. And then they will test you by giving two balance sheets. So your first task will be to decide which balance sheet to choose. So we have to give preference to balance sheet of preceding accounting year. But if there is growth of more than 50% in the assets book value, then take the balance sheet on transfer date. And then see, if the conditions are satisfied, we will say capital gains accrued in India. India can tax, but India can tax full capital gain or proportionate. Proportionate. It depends upon this 60%. Huh? Don't buy at 60%. Huh? In my example, 60 because market value of Indian assets is 18 crores compared to the total market value of 30. Because this is 60%, India can tax 60% capital gains in India. So this was one point in capital gain. Yes. Means this German company, yeah. See, her doubt is what you look here. Look, her doubt, I'll put up her doubt properly. In my example, there was a Singaporean shareholder having shares of German company. Now she is saying that what if the German company has become R because of poem? Foreign company can also be called R if their poem is in India. But see, to decide whether capital gains is of India or foreign, Indian company, foreign company is important, not the residential status. See, in general, once the shares are of foreign company, it's a capital gains of foreign. Not just shares, debentures, bond, any security pertaining to foreign company, it's accrued in foreign only. Then residential status doesn't matter. So see, even if that German company in my example, it has its place of effective management in India, although it can become R, but then basically it's a foreign company, na? And foreign company shares, capital gains are accrued in foreign only, except this situation. See, this was a situation which I created, that more than 55% shareholder, this 10 crores and 50%, then it's a different thing. But in general, once the company is foreign company matters, not their residence status. This is in relation to which point, when I was saying, how do we know location of asset? So land, building, gold, etc., we can physically see where they are located. But for shares, debentures, bonds, we have to see the company. Company means not the status of RNR. Indian company, foreign company depends upon incorporation. If the company was incorporated in foreign, and if foreign company's securities you are holding, then it's located abroad. But sometimes even though located abroad, it's deemed to be accrued in India if you satisfy this condition. Okay. So this was capital gains head. Last head of income is what? Income from other source. Even this is interesting. You know, if you see study material or Bare Act, Section 9 is given in a very messy manner. I have given in organized pattern, you know, headwise. Headwise it becomes simple. Okay. But this headwise method is not adopted by neither the act nor your study material. But best is headwise. Now what is the last head of income? Income from other source. Now see, for income from other source, when can we say his income is accrued in India? See, our task is what? We want to decide NR's income is accrued in India or not. So generally what is the rule? If the source of the income is in India, the income from other source means income is coming from some source, na? Source. So if the source is in India, income is accrued in India. So this is a general rule. Now here comes two special points. First point is of gift. Let me explain gift. You know, under income from others, so if the gift is of more than 50,000, the receiver of the gift has to pay the tax. There are exceptions. Marriage gifts are exempt, relative gifts are exempt. But under friends, if there is a gifting of more than 50,000, it is taxable or not, this you know. But now answer. Imagine some Singaporean guy. In all my example, I am assuming that NR is of Singapore. Don't buy at Singapore. Huh? So assume there is some Singaporean guy, non-resident. He got gift of more than 50,000 from Shirish. Now whether it will be accrued in India or not. Who got gift? Singaporean guy NR. Who gave him the gift? Shirish. But you know, Shirish gave him gift when? When I visited Singapore. Imagine I went with my family to Singapore. On Singapore land, I gave him gift of 1 lakh because he gave me good service. Due to any reason, I became friendly with him, and out of my friendship, I gave him gift of more than 50,000. Let's assume 1 lakh. But what is the location of gifting? Singaporean land. Means I was standing in the land of Singapore. He was also standing in the land of Singapore. On Singaporean land, gifting happened. So tell me, income is said to accrue where? So here you don't have to see the location of gifting. You have to see the status of the giver. Who is the giver of gift? A Singaporean guy got the gift, but who gave him? Shirish. You have to see the residential status of Shirish. Shirish is resident. So gift accrued in India. See, although I gave him the gift in Singapore land, you know why I am trying to stress on Singapore land? Basically what I want to show, although gift I gave him when I was there in Singapore, and he might say, I got gift in my country when Shirish came to my country, but gift you thank to whom? Giver. See, for gift you thank to whom? Thank you giver, and giver is Shirish. He is a resident of India. So gift has accrued in India. In short, we have to check the giver, not the place where gifting happened. So in my example, gifting place was Singapore, but that is not irrelevant. What is relevant? Status of giver. So in my example, giver was Shirish, and if the giver is resident, income is accrued in India. So this is important. So tell me, once again answer this, that Singaporean guy got gift in India, and the one who gave the gift was NR. Some NR was there in India, he came for tourism in India, some NR gave gift. So now don't see the place of gifting, see the status of the giver. So if the giver is NR, income is accrued outside India. But if the giver is R, accrued in India. So this was little tricky, na? That's why I kept a star mark there. Now, see, his doubt is what? NR gifted to someone. Tell me, gift is income for whom? For the receiver. So think from a receiver angle. Receiver has to decide whether accrued in India or not. So his doubt says what, NR gifted to some another NR. So it is whose income? Another NR's. NR gifted, but he gifted to some another NR. But who is the receiver of the gift? Another NR. Now another NR will think who is the giver? NR. So income accrued outside India. See, think from person who is earning the income. Tell me for whom it's a tension, income is accrued in India or not. For the one for whom it's an income, na. In my example of Shirish Vyas, was I thinking from Shirish? See, Shirish I saw for deciding the accrual, but it was income of NR, that Singaporean guy. For him, it matters whether the income is accrued where. So always think from person who is earning the income, na? Because this theory is what? Section 9 explains what? Income when it is accrued in India, and income is for the one who is earning the income, na? So see, in this whole topic, you have to think from NR. Imagine NR earning income. Imagine NR earning income. But his income is said to accrue in India what? So depends. If NR is earning gift income, we have to see who gave him the gift. Giver. Okay. And if the giver is resident, NR will say my income is accrued in India. Okay. No. See, in gift, if gift is given of property, so where the property is located, not important. Tell me, in gift, when you will thank whom? You will thank the giver. Like today, I also get some gift from some ABC person. I will thank the giver, na? So for gift, the income is thanks to the giver. So giver is to be seen. His doubt is now what but if the gift which we got is of a property located in Russia, Africa, why do you have to see where the property is located? The property location we see in capital gain, because capital gain comes out of the property, but gift comes from the giver. So giver is important. So see, in my example, if Singaporean guy, once he gets the gift from Shirish, even if I gift him some American property, I gave him some American property. Don't see the property is America. It is gift, na. So see the giver. Giver is Shirish. He is resident, accrued in India. Okay. In short, don't see the gifted item. Don't see the gifting place. See the giver. Then next point is interest, royalty and fees for technical service. This is, trust me, very important point. Whenever such point comes in exam, student gets trapped, because your paper setter will play tricks and you will get trapped. See, first understand, I am explaining interest, royalty, income. Huh? See, every point I am discussing is some income, and these are income from other sources. Now see, one by one. First, let me take one example of interest. Focus properly. Example of interest. Imagine, see, in every example, I want to create some NR is earning income. NR is earning income. So imagine some Singaporean guy, some non-resident. He has given loan to Shirish. He gave me loan and I am paying him interest. I pay interest. For me, it's a payment, but for him, it's an income. So see, I created a situation of NR getting interest income. See, please by heart the example, then only it will become simple. So tell me, in my example, what is happening? Singaporean guy has given loan to Shirish. Don't see the loan. Now see the flow of interest. Who will give interest? Shirish will give interest to NR. So see, Shirish, I am right here. Shirish Vyas is giving interest to NR. So tell me, it is whose income? Shirish Vyas has made the payment, but it is whose income? It is NR's income. So tell me, is it accrued in India in my example? He is getting interest from Shirish. SV. He is getting interest from Shirish. So generally what a student will think? Yes, it's accrued in India. Because he is earning interest from Shirish. Shirish is of India. Don't see Shirish. See the business where the loan is used. Now see the twist. I took loan from NR for my business in Australia. Tell me why I am giving him interest. Why I am giving him interest? Because I have taken loan. So you have to see the use of the loan. And if I say the loan was taken by Shirish, but it was used for my Australian business. If the loan is used in Australian business, income is accrued in Australia. It looks like what? No, but that NR has got interest from Shirish, na? Income is coming from India, na? The income is coming from India. But what is the source of the income? Interest comes from what? Loan. Where is the loan used? It is used by Shirish. But where it is used? In Australian business. So income is accrued in Australia. You know, such point if it comes in exam, 90% students will see what you know. Oh, he is getting interest from Shirish. Income accrued in India. But somewhere in the corner they will write, Shirish took loan for his business in Australia. So income is accrued in Australia. You know, in my Hindi batch, I use one dialogue. Banda mat dekh, dhanda dekh. Banda means person. Dhanda means business. Don't see the banda. Banda means Shirish. See the dhanda. Dhanda means business. So what rule I follow? Did I see Shirish? See, if I stick to Shirish only, my answer will be what? Oh, NR is getting interest from Shirish. Shirish is of India. Income is accrued in India. I will give a wrong answer. So don't see the person. See the business. In my Hindi batch, I say, Banda mat dekh, dhanda dekh. Okay. Now answer this. Same example. Shirish took loan from Singaporean guy NR. And Shirish is paying interest. But I took loan for my coaching class in India only. I took loan for my coaching class setup in India. So it is for business in India, so accrued in India. In short, what was the message? Don't see the banda, see the dhanda. Banda means don't see the person. Okay. See the business. But see here, there is an exception. Look here, look. Please see the exception. Look here. I am making one change. Cancel Shirish Vyas. Government of India. Now imagine, Government of India borrowed from that Singaporean NR. And Government of India is giving interest to NR. But you know, again you will try to figure out what? Oh, Government of India took loan for what purpose? So let's assume Government of India took loan for business in Mauritius. Means our Indian government wants to do business in Mauritius. So business in Mauritius. So as per my dialogue, what you will do? Banda mat dekh, dhanda dekh. Means don't see the person, see the business. So government has taken the loan for business in Mauritius. It looks like accrued in Mauritius. But government is an exception. Once NR gets income from government of India, accrued in India. Here it is reverse. Banda dekh. Dhanda nahi. Because banda is a respectable banda. Government of India. Not just chiller pillar like Shirish Vyas, etc. So in short, conclusion is what? Answer once again. Look. This and see the drawing. NR is getting interest for the loan given. So who is earning the income? NR. So tell me, if it is from Government of India, what is the rule? Answer fast. Then we will not see why did government take the loan, what is the use of the loan. Government of India accrued in India. But instead of Government of India, some other guy is there, Shirish Vyas, etc. Then don't see the person, see the business. Person may be Shirish of India, but don't see the banda, see the dhanda. Dhanda means business. If the business is in India, accrued in India. If business outside, outside India. Same rule you have to follow for royalty, fees for technical service. What is the only change? Look. Shirish will give interest if he has taken the loan. But now Shirish will give royalty if he has taken a patent. So same example I am just repeating. Imagine I have taken the patent of some Singaporean NR. And Shirish is paying royalty for that patent. So now what you should check? Don't say Shirish is giving royalty. Shirish accrued in India. It's wrong. Banda mat dekh, dhanda dekh. So what you will ask? Shirish has taken the patent for what? For his business in Australia. Assume for the business in Australia. So patent used in Australia, so accrued in Australia. In short, I am repeating. And again, if not Shirish Vyas, if Government of India, then straight the conclusion is accrued in India. So see the conclusion. Look here. If for the NR, if the giver is Government of India, then see what I have written. Accrued in India, correct? But if the giver is not Government of India, then what you will see? If the loan, patent or technical service, if it is used in India for the business in India, then accrued in India. Please don't see Shirish is giving or Reliance is giving. Who is it? Don't see the giver. Don't see the banda. You have to see the dhanda. Okay. So see, use means it is used for which business? Like interest is for the loan. So loan is used in which business? If it is for Australian business, accrued in Australia. And if royalty is there, it is for patent. So patent is used in which business? So you have to use you have to check the use of underlying loan, patent and technical service. Don't see Shirish is giving, na. The best dialogue is what banda mat dekh, dhanda dekh. But this protocol you have to follow when interest, royalty and fees for technical service. Trust me, I feel this is very important because see, if I would be a paper setter, I would love to play tricks in this point. Okay. Best trick is what I will create a situation where Shirish is giving interest, but Shirish has taken loan for Australian business. Most of the students will be trapped. Most of the students will think what Shirish is the source of revenue for him, so income accrued in India. But that's wrong. Don't see person, see the business. So finally, Section 9 is done. Okay. It is done thoroughly, exhaustively. Section 9, and this is most important. Okay, then see what is the status of the chapter. We have done special rates, presumptive taxation we have done, resident status, poem concept I have explained, and then Section 9 we have done income deemed to accrue in India, and conversion benefit is already done. Now what is remaining in this chapter? Section 172, Section 44C and certain exemptions which are dedicated for NR under Section 10. Okay, 3 things are remaining. So I'll take one by one. First, let me take Section 44C. Section 44C. Actually, this section is from the topic of PGBP. But our study material has kept this topic in NR taxation because it is something special for non-resident. But technically, this section is from the family of PGBP. If you remember, already in PGBP, there were sections from 28 to, there were many 44s. At the end, we had done some 44 section in PGBP. So it is amongst them only, okay. So it is a section from PGBP, but we are studying in NR taxation. Now see, 44C is for what, deduction for head office expenditure. Can you guess what is this HO expenditure here? See, I will create one situation of head office and branch. Head office and branch concept na? So assume there is one big company X Limited. It has head office in France. Can you see HO? The main company is located in France. But it has got one branch in India, one branch in Singapore, one branch in Australia. These are the three branches. Branch means we can call it as permanent establishment. Having a branch in another country is like having a permanent establishment in India. So see, France company has got one branch in India, one in Singapore and one in Australia. Now tell me, can Indian government tax this France company on the world profit? Can Indian government tax this France company for the whole world profit? No, because basically this company of France is my assessee and assessee is a non-resident. Because company in France, having head office in France, that means they are a foreign company, and assume their poem is also in foreign. So they are NR, and for NR what is the rule? India cannot tax them on world income. India will tax only Indian profits. So only profits generating from Indian branch will be taxed. India cannot tax Singaporean profit. India cannot tax Australian profit. India cannot even tax the profit generated in France. India has got right to tax on profits which are generated in India. But tell me, how to calculate profits of India for this branch accounts? In accounts also you have studied branch accounts. So branch will have to prepare separate accounts. Which branch? Indian branch. Tell me, why did I put cross mark here? Because Indian government does not have right to tax profits in other country. Because the assessee is NR, we will tax only profits of India. But India profits has to be calculated by preparing separate trading P&L account, balance sheet of India. But when Indian P&L account is prepared, in Indian P&L you will find HO expenditure. Tell me, in Indian P&L, this is a profit and loss account of Indian branch. What will appear? All expenses of Indian branch and all income through Indian branch. Understood or not? Obviously the accounts is of branch of India, so expense income is of Indian branch. But there will be some common expense which are general. H office, head office expenditure. H office means head office expenditure. Like see, head office is of France. Whenever there is a setup of head office and branch, there are some common expense which every unit has to bear. Like there are 4 places, 4 locations, HO in France, then India, Singapore, Australia. Every location will have to share some expense. This is for common expense. See, some expenses are branch specific. So if there are some India branch specific expense, it will be debited to Indian P&L. But imagine if there are some general expenses which are of general character, who will have to bear? All branches. But what these people do? They will allocate more HO expense to India branch to reduce the tax in India. Let's assume in Singapore tax is 0%, Australia tax is 0%. Okay. But in India, foreign companies have to pay 35% tax. Don't you think foreign companies might be finding 35% horrible? So how to reduce the tax? What will they do? All the common expenses which are general administrative expense, they will allocate more to Indian branch. So that Indian branch profit reduces. This cheating is generally done by foreign companies. So to control such cheating, there is a limit. There is a limit on how much HO expense you can debit in Indian P&L. Can you see India's P&L is like this? India's P&L is basically for Indian operations. But we will put a limit on charging HO expense in Indian P&L so that Indian profits will not be manipulated. So for that there is a section. So see, in exam, they will give one profit and loss account of what? Indian branch, of India branch. And debit side, they will write head office expenditure. Means precisely they will write HO expenditure allocated to Indian branch. So tell me, you should doubt the amount debited in P&L. What doubt should come? Definitely head office might have apportioned more amount to Indian branch so that profits of India reduces. But we will disallow this. And then we will allow this according to a limit. There is a limit. Maximum 5% of the total income of Indian branch. Whatever is the total income coming from Indian branch, whatever is the total income coming from Indian branch, 5% of that, more than that you cannot charge in India P&L. So if the actual expense charged are more, the deduction will be limited. See, basically I am teaching some PGBP deduction. So what is the limit? 5% of the total income of India branch. See, why I am saying India? Because they have got business worldwide. But right now we are dealing with India profits. So whatever Indian branch has made total income, 5% of that is the limit. But tell me, if in the P&L of India branch, actual HO expenditure is very less, then it is fully allowed. See, whenever there is a limit means it cannot be more. If it is less, it's okay. So there is a formula, whichever is less. See this formula, see this. Actual head office expenditure debited to, tell me fast, debited to profit and loss account of Indian branch. Indian branch will have a separate P&L because India will tax only Indian branch profits. So actual expenditure debited to Indian branch P&L. Compare with 5% of the total income of Indian branch, whichever is less. This is the limit. Now the question is 5% of what? Adjusted total income. How to find adjusted total income? This I will explain now. Okay. See, adjusted total income is calculated like this. See, total income means what? All 5 heads. All 5 heads. See, I have written here also. Income under other heads. Means PGBP will be taken and you will take all heads. So see, firstly you fix this in mind. When we say total income is all heads of income which this Indian branch has generated, all heads. But in all heads, PGBP income will be what? Before allowing HO expenditure. What do you mean by before HO expenditure? Means in the profit and loss account, whatever HO expenditure is debited, you will add back to the net profit. See, our net profit is after HO expenditure. Net means net, na? So you will add back HO expenditure because for HO expenditure only we are deciding the limit, na? So whatever is debited, reverse it. So it is called before HO expense. And then one more thing you will add back. In PGBP there was one keyword C/FR. When I explained section 36(1), there was one keyword C/FR. In that, what was F? Deduction for family planning expenditure. If a company has incurred family planning expenditure for promoting family planning awareness amongst the staff, what was the rule? If there is some capital expenditure on account of family planning, 1/5 of that is allowed. So allowed means it is allowed as deduction. So see, in your final PGBP income, you should have claimed deduction for family planning expenditure. But this you will have to reverse. Tell me how much deduction you have claimed. You will have to refer PGBP. Students who are watching video lecture, if you have forgotten PGBP, please open the notes of PGBP. In PGBP for family planning capex, capital expenditure, 1/5 was allowed. So actual PGBP is after deduction, but government says add back this. Tell me, if it is add back, it is a good rule or bad rule? It's good. Why? Because this amount will become big. And 5% limit will be big. It is good. And you know why this goodness government has done? Because government feels this expenditure is not a true business expenditure. Actually, family planning promotion, government wanted to promote for population control measure. Why the deduction for family planning came in PGBP? Idea was what? Corporate should do some family planning activities so that population control measure is there. So it is not a true business expense. So government said that actual PGBP you will get the deduction, but we will reverse it. So this is actually in the benefit of the assessee. Why benefit? Because if you reverse it, this figure will become bigger. And if this becomes bigger, your limit will increase and you will get more deduction. And see, now you will wonder, but sir, why only family planning? Actually, you know, when this section originally started, there was one big list of add back. But all those sections have become outdated in terms of current law. So now in add back only one item is there. And when I say only this item add back, students find it little weird. Sir, out of such a big topic of PGBP, you are saying add back only. See why add back I am saying? Because in PGBP computation you have taken all deductions. So family planning expenditure deduction is actually allowed. But just for calculating 5% limit, you will temporarily add back. But the question of a student is why only that? So actually speaking, the inside truth is what you know, there were few more items which we used to add back long back. This section when it came, it said family planning expenditure and there was something called section 33, 33AC. Some sections were there which are not existing now. In our law, we have 33AB. But there are some other 33 sections. Means there were some things which government felt they are not the real business expenses. Like family planning also, it's a population control measure. Like that, there were many more sections which were not creating some real business expense. So government used to add back all such. But today, those other things are not there in the law. So in our current law, there is only one item, family planning expenditure, which is to be add back. Okay. Anyways, let's not go into the depth. Sometimes, you know, when the law evolves from year to year, from budget to budget, sometimes we land up at a funny situation. So right now, a funny situation is only one thing. Why? There were few more things which we used to add back. But anyways, what you will do in exam, just add back one item. Which item? Family planning. Actually, see, first you will calculate normal PGBP. Normal PGBP without allowing HO expenditure. What do you mean by calculate normal PGBP without allowing HO expenditure? Means this you will disallow. You remember PGB how we used to solve tick mark, cross mark, tick mark, cross mark. First calculate normal PGBP, disallowing HO expenditure. And then in normal PGBP, you might have claimed family planning expenditure also. But you add back that. Add back only for the purpose of 5% working. When you prepare the main 5 heads of income, their family planning expenditure deduction is allowed. Then you will subtract once again. For the timing, add back. And then add all other heads of income. See, basically it is like gross total income only I am taking. But why I am saying gross total income? Because in PGBP little tantrums are there. See, other heads I am taking as usual. What are the other heads? House property, capital gain, income from others. So just take as it is. In PGBP, two things you keep in mind. Before HO expense and before family planning capex. These two things you keep it before. All other heads you add. This will give you adjusted total income. And here law has clarified, don't subtract brought forward losses. Don't subtract unabsorbed depreciation. Don't even subtract chapter 6A. Because this is actually in the nature of GTI. If it is really in the nature of GTI, chapter 6A will not come, na? But law has clarified, don't deduct chapter 6A, don't deduct brought forward loss and unabsorbed depreciation. Tell me, this is a good thing or not? If government would have said deduct brought forward loss also, deduct unabsorbed also, then this amount will become smaller and assessors limit will become smaller. But at least government has kept this humanity that they are not adjusting brought forward losses. Okay. Brought forward means brought forward. Current loss you will adjust. See, current, because basically this is current year's total income. Current loss you will internally adjust, but you cannot adjust brought forward things. Okay. See, this if you can successfully calculate, your answer will always go right. You know, in few past papers, they've asked question on just calculate this amount. Only this formula knowledge was tested. So tell me how simple it will be. Actual HO expenditure will be given in the question. 5% you have to by heart. The only challenge is how to calculate adjusted total income. And for that the rule is what? PGBP, you have to ignore two things. What? HO expenditure add back and family planning 1/5 capital expenditure also add back. All other heads of income add. Combine all the incomes. Don't take brought forward losses, don't take unabsorbed thing, don't take chapter 6A. This is the working for adjusted total income. Take 5% of that, compare with the actual, whichever is less. So this much deduction you get in 44C. Okay, 44C. So 44C is done. Today I will give you one homework question which will test 44C. That will be interesting question. There you will actually practice how to work out 44C. I will not directly do this sum. First you will try and then I will discuss. Okay. And since 44C means it will be basically small PGBP type question only. Okay. Then see, look here, look. 44C is done. Next is section 172, special provisions for shipping business. Okay. Special provisions for shipping business. Look at this. Look. Look. Tell me, for shipping business, one knowledge I have already given. What? That if a non-resident has shipping business in India, how do we compute his income? Gross receipts 7.5%. And what do you mean by gross receipts? Bookings in India, receipt outside, plus booking outside, received inside, plus booking inside, received outside, that also. What you ignore? Bookings outside, received also outside, that you ignore. And this way you calculate the gross receipt and you take 7.5%. That was under which section? 44B. But you know, that section was explaining the method of computing PGBP. Now, for that same non-resident having shipping business, there is one more section. You know, it's like you can say, for non-resident having shipping business in India, there are two sections. One section is 44B. It explains the method of computing PGBP. There is one more section, 172. What is this? This I will explain. Now look at this. You know what section 172 says? Whenever the ship departs from India, you have to file one voyage return. Which return? Voyage return. Which return? Voyage return has to be filed whenever any ship of non-resident departs from India. Logic I will tell you. So imagine if during the year the ship of non-resident departed 3 times. 3 times it departed from India. Every time the ship departs from India, you have to file voyage return. See, voyage means one journey. So if there are 3 departures, there are 3 voyages. So for each voyage, you have to file the return. And you know, in this return, what you have to show? In one particular departure, how much booking you took in India. How much, like see, in the month of September, ship departed from India. It went to Dubai, London, wherever. It departed from India. So in that departure, how much cargo was booked? Cargo, passenger, total bookings. You have to report to India. And you have to show 7.5% of that booking, and on that 35% tax you will pay, otherwise your ship will not be allowed to depart. Means it is not for a easy for a non-resident to depart the ship from India. See, basically purpose of this section is what you know, sometimes there are some occasional shippers. Occasional means what you know what they do? Actually the ship is sailing in foreign waters only. But suddenly one day it came to India. It came to Mumbai port. But now when the ship came to Mumbai, it will not go empty, na? So what shippers might have thought, in Mumbai, let's book so much cargo as much as possible, and then they might run away. The ship will never come. So this is the fear government of India has got. See, we never know whether the shipping is regularly coming to India or the ship is occasional visit in India. You never know, because see, once the ship is in India, we'll like seeing them. But once they go away, God knows they are lost. They may never come. That's why there is a rule. Once a ship has come into Indian waters, and if it wants to depart, you cannot depart without paying the taxes. And this tax is kind of an advance tax. See, when they actually file the return after the year is over in the assessment year, whatever they paid right now, it will be adjusted. Like see, imagine during the year ship departed 3 times. So every departure you have to pay little tax. And this tax is like tax paid in the previous year only. It is kind of an advance tax. It will get adjusted when you file your main return. If you file the main return, adjust it. But you know, sometimes the ship just came occasionally. Now it has went forever. It never comes to India. So that's why we secured our tax, because our rule says that if you want to depart from India, customs will not allow without income tax clearance. And when will income tax give the clearance? If you file the voyage return, means you have to fill one form and you have to say that in Indian port we have taken so much of booking, and according to the booking 7.5% is deemed income, and of that 35% tax you have to pay. You know, 35%, although that shipper might be individual. Although that shipper, non-resident, might be individual. Individuals are subject to slab rate. But government wants the tax on higher side, 35%. Because see, this is like, you know, we are provisionally recovering the money. You understood what is the fear of the government? What if the ship departs now, it never comes back to India? So at least we secure the revenue on higher side. Higher means 35%. That non-resident will say, but we are individuals, we are subject to slab rate. Okay. That you tell us when you file the main return. Main return when you file in the assessment year. Right now we will treat you like a foreign corporate. You have to pay 35% tax. See here. Look, read this. Before the ship departs from Indian port, master of the ship, you know, every ship has a master. It is his duty. Because see, the owner of the business is non-resident. He might be staying in Dubai, London. He will not come with the ship, na. Owner is non-resident. He stays in his country. But in this ship, there will be a master. So what is the duty of the master of ship? File a voyage return and pay the tax. You know, in this voyage return, you have to show what? From Indian port, what is the gross receipts emerging? See, here you don't follow the rule, huh? Freight booked outside but received in India. See, here you don't follow the rule of accrued in India or received in India. Here you have to show in the return only Indian bookings. Basically, you have to tell government that at Indian port we took this much booking. Whether the money is received here, received wherever, whatever booking you took at Indian port, that you have to show, and tax also you have to pay on that. At what rate? 35% of 7.5% of Indian booking. Tell me why 7.5%? Because what booking you took at Indian port, that is a gross revenue, na? Gross. PGBP will be 7.5. This mechanism we already studied in 44B. So 7.5% of gross receipt will be my PGBP. Tax will be 35%. This much tax you pay, then only your ship will be allowed to leave from Indian port. Otherwise, customs will not allow you to leave. Because in customs department, you have to produce the proof that you have filed the voyage return and you also paid the tax. Now see, this drawing is worth noting. Huh? Look at this. This will give you full clarity. Just notice, you will understand automatically. What is our previous year in exam? 25-26. Okay, PY. And what is our assessment year? 26-27. Now tell me, generally when do you file the return? What is the due date of filing the return? Either 31st July or 31st October. So in 31st July and October, the return which you filed is called the main return. And that time you pay your final taxes. But what is happening during the previous year? See and understand, na? If there are 3 departures from India, assume 3 assumption. 3 departure is my assumption. Departure 1, departure 2, departure 3. At the time of every departure, what is VR in tax? File voyage return, pay the tax. See, you might be thinking, sir, so many times you will pay tax. See, every time you pay the tax, is a tax on that departure's booking. Like see, for example, in this departure, there was booking of 100 lakhs. So you pay tax only on bookings of 100 lakhs. Then in the next departure, see departure 2, there was another booking of 60 lakhs. Then what will you do? You will pay tax on 60 lakhs. See, 60 lakhs is the booking. Booking means is the gross amount. First you will calculate 7.5% and then tax will be 35%. So see, it looks like you are paying the tax again and again, but it is not the same tax you are paying again. Na? First time when you paid the tax, it was on which booking? Booking in first departure. Then second departure will have fresh booking, na? So that will be another fresh tax. And third departure will have again fresh bookings. So every time there is, see, booking, you understand or not? See, in Indian port the ship is actually empty. Now people are placing the order. We want to transport 10 containers. We want to transport 15 containers. So that is the booking we are taking. So every departure the bookings are fresh. And you are paying the tax in piecemeal. For each departure you are paying the tax. And return also you are filing for what? Not whole year return. Departure, see, name is what? Voyage return. For that particular voyage, in that particular departure, how much cargo was carried, how many passengers were carried, how many livestock was carried. Even livestock are transported through ship. Huh? In that voyage, what was the booking? So that you have to show in voyage return and pay the tax. So see, it looks like, it is so tedious. Every time departure, we have to do this. But you understand the sentiment of income tax people. You know what they are worried? What if after the first departure, ship never came to India, now they are absconding and we would have left them easily without asking them to pay tax. How will government get tax? And imagine in one departure, they take booking of 100 lakhs. Such a huge booking, they make huge, ships are big in size. So imagine if this rule was not there. See, in my example, the ship has come multiple times to India, but who knows now? What if in one departure after that they never come? That's why government wants to secure the revenue. So see, what is the title of the section? Recovery mechanism. It is a way to recover the tax. Okay. Now tell me, at the end of the year, what is the conclusion? How many returns you filed? 3 times. And how many times you paid the tax? 3 times. But now, when assessment year comes in the month of July and October, you will file your main return. Now, you know what will come in the main return? In main return, you have to show all 5 heads of income. And in PGBP, how will the working come? You know, like this. See, wait, where is that 44B? In main return, you will show like this. What? Bookings in India or received in India or both in India. You will show everything. That is in the main return. But in voyage return, you have to show only bookings in India. See, voyage return is a time pass return. It's not the actual calculation. See, voyage return means what? In that voyage, how many booking happened in India? So tell me one minute difference. If you see, when you file voyage return, you have to report what? Bookings in India port. Bookings in India port. So that means, see, in my example, which amounts you will do reporting? 100 CR and this 100 CR. That's it. Because voyage return means what? In that voyage, how much booking you got. So it is not the actual calculation. See, here when I explain, it was the actual working. Actual working is while the main return is filed. So tell me distinction between voyage return and main return. Voyage return you file at the time of each departure. Main return you filed in July and October. Voyage return you have to show 7.5% of only Indian bookings. In my example, only 200 crores will come. Bookings in India, that's it. And that also you have to show not in one stroke at the time of each departure. But in the main return, look, in the main return, how will you show? There the concept of this concept will apply. Either the income accrued in India or received in India. So tell me, in the main return, what you will show? This you will show because accrued in India. This also you show because it's received in India. And this also means you will show precisely 300 crores. So with amount, if you remember, in voyage return, I will show 200 crores. Of that, 7.5%. And in the main return, 300 crores of that 7.5%. And in voyage return, tax rate will be 35%. In the main return, tax rate will be slab rate also, depending upon the assessee. And in voyage return, only this reporting you have to do. In the main return, all 5 heads of income. And when you file the main return, whatever taxes you have paid at the time of each departure, it will be adjusted like advance tax. See, you know, this clarity people don't have. You know, there is a major confusion in the market. What confusion? That what is the difference between 172 and 44B? They get confused. So see, difference is clearly highlighted. Read here. Can you tell me what is the main difference? 44B has just explained the computation mechanism. That for shipping people, the method of computation will be 7.5 method. Now that method you follow at the time of voyage return also, at the time of main return also. It provides the method 7.5% mechanism. But what is the feeling of 172? It wants to secure the tax before the ship leaves India. It's a recovery mechanism. Then 44B says PGBP will be 7.5% of gross receipts. But 172 says pay tax before leaving India. See, this has created a computation mechanism 7.5%. And 172 says what? We are not teaching how to compute. How to compute 44B has explained. 172 says what? Before the ship leaves India, pay the taxes. Okay. See, once again for my satisfaction, give me the distinction between voyage return and main return. Answer. Voyage return is filed only once or multiple times. Multiple, every departure, every voyage. It is voyage wise. Main return is only once for the whole year. Then other difference, in voyage return you have to report only the bookings in India. Means in that example 100 crores, only 200 crores. Only you have to report the bookings of that particular departure. Bookings took place in India. That means if booking has taken place outside, received here, don't take. Because that is not from Indian departure. No? So first was multiple return. In main return, only one return. In voyage, you have to show only Indian bookings 7.5%. And in the main return, Indian bookings also and even foreign booking if received in India. Okay, both are according to 7.5%. But in voyage return, you have to report only PGBP. In main return, you have to report all 5 heads income. In voyage return, you have to pay 35% tax, corporate rate. In main return, depending upon the assessee, slab rate, etc. And since in the main return, your tax will be little different. Your tax which you paid at the time of each voyage will be adjusted. And if you paid more, you will get the refund. If you paid less, you have to pay the balance. Okay. See, I'll do one thing. I will immediately take one question of this so that this gets over today only. There is only one small question of that. It's simple. There is nothing like first you try and then I'll discuss. Nothing so special here. So this question is dedicated on what I am explaining right now. 172 section. Wait, one thing I forgot to say. See, this voyage return when you file, tell me in my example how many times you filed voyage return? 3 times. For each voyage return, AO should do the assessment also. But this is not our regular type of assessment. See, our main regular assessment happens when? Within 12 months from the end of AY. Remember my first topic, assessment. But see, that is the main assessment. But for voyage return also, there is some temporary assessment done within 9 months from the end of the year when voyage return was filed. So tell me, when did you file the voyage return? You filed it during the previous year only. So what is the end of previous year? 31st March 26. So within 9 months, they will do the assessment also. The assessment means basically they will approve. They will say, okay, we are happy with your voyage return, everything is good, everything is good. See, government is expecting from them to do the formality, file voyage return, file. Even government has to respond that, na? See, whenever people file the return, they want the response from IT. So we filed the voyage return, but government should respond. So they will do assessment, and this assessment is not dangerous. It is just they will acknowledge. They will kind of acknowledge, yes, we received your voyage return, it's good, everything is good. You are not a defaulter, good. But that they will do when? Within 9 months from the end of the year, voyage return is filed. And generally voyage return, always voyage return will be filed in the previous year only. So from the end of previous year within 9 months, that assessment will be done. But this is not the main assessment. Main assessment will happen when? After the main return is filed. From the end of AY, 12 months. So in my distinction, you can add one more point. Voyage returns assessment happens within 9 months from the end of the year. Voyage return is filed. Main return assessment will be done within 12 months from the end of AY. That is our regular assessment, etc. That distinction, see this distinction things you should actually write. See, apart from the notes which you are supplied through my iPad, I would advise you should write some extra thing also whenever you feel something extra was worth writing. See, here I have written it is kind of an advanced tax. One more thing, last thing. You know, master of the ship has to make sure that the voyage return is filed and he has paid the tax. But sometimes, you know, the ship is in hurry to depart. The ship is in hurry to depart. And you know, it is so urgent for them to leave India, and doing the formality of filing return and pay tax will delay. So there is an option. If master of the ship ensures IT department that please let us depart. We promise. We have an agent in India. We have an agent in India. It will do all the formality. You can request, and if IT department thinks you are genuine people, they will say, okay, after the ship departs, within 30 days, do the formalities. This is an exception. See, generally, before ship departs, master has to do. But sometimes you have to depart in emergency. You are in hurry to leave, and doing this formality before departure will take time. So you can request income. Who will request? Master. To whom? Assessing officer. And if assessing officer is convinced, he will say, okay, tell your agent in India, to do the formality within 30 days from the date of departure. This provision is also there. Huh? Now see how this is tested in exam. Look, this is one exam question. Read. Neptune is a ship liner used in carrying passengers and cargo. You know, this is the name of the ship. This is not the name of the assessee. This is a ship liner, name of the ship. And assessee is Thomas and Thomas of UK. Means there is some non-resident assessee called Thomas and Thomas. And what is the name of the ship? Neptune. The ship carried passengers and cargo in June 25 from Singapore to Chennai and vice versa, and collected charges thereof amounting to 200 lakhs. Means 200 lakhs was the amount of booking. Okay. It left Chennai port on 15th June for its journey to Korea. No other journey to India was undertaken by any vessel of the company. Wait, please explain me how the journey has taken place. Because when you read independent, you will find confusing this thing. Please read this once again in your mind. What they are saying? Ship carried passengers and cargo from Singapore to Chennai and vice versa. Means Singapore to Chennai, Chennai to Singapore. And then they are saying Chennai, see, that happened in June, and on 15 June the Chennai ship left from Chennai port to Korea. So wordings of the question is very confusing. Actually see the stories like this. You know how the stories look. From Singapore, it first went to Chennai. Then it actually wanted to go to Korea, but it went via Singapore. En route to Korea, they had gone through Singapore. So see, here vice versa thing has also come. See, I am convincing this vice versa means what? Singapore to Chennai, Chennai to Singapore, vice versa journey, and then they are going to Korea. So obviously they are going to Korea through Singapore. So eventually it went to Korea. So see, this sentence means what? You read this sentence. It left Chennai. So see, look here, look at the drawing. It left Chennai for journey to Korea. But it was via Singapore. How do I know it's via? Then only that vice versa thing will be satisfied now. See, actually this thing is totally irrelevant in the question. But it is my duty, because a student, if he gets confused in the wordings, I have to explain. But right now, when you see the ultimate question, you will find all this was totally irrelevant. The question is complete theory question. But first you understand what they are saying. They are saying from Singapore it went to Chennai, and then it left Chennai to Korea via Singapore. Now, read this. The non-resident company, means Thomas, has authorized an agent in India to comply with income tax provisions. Read the main part of the question. Read. You are consulted by the company to explain about the procedure as to return of income to be filed and the period within which assessment will be completed by AO. Focus on the question. Procedure, period. Procedure, period. This way you have to handle exam question. You know, students, what they do? they get lost in the main para. Ignore this. Focus on what is asked. So tell me what is asked in the question. Procedure. Procedure as to filing of return. And for that, we are chartered accountant. Who consulted us? Thomas. So tell me, if Thomas consults me, I am a chartered accountant, what advice I will give him? I will tell him, see, from Chennai when you are departing, you will have to file voyage return before it departs from Chennai. See, from Singapore it came to Chennai, it can come. But when it departs from Chennai, when it is departing on 15th of June, see, I have to give consultancy. So my consultancy is, when the ship departs from Chennai, you have to file a voyage return of the bookings at Chennai port and pay 35% tax. This is the advice to be given. Okay. And if before departure you cannot do, you can do it within 30 days from after departure. After departure within 30 days. But that if approved by AO. And see, they have got agent also in India. See, they are not asking something in general way they are asking. So all advice you have to give. See, if really I have a client who is non-resident shipping, obviously I will advise what? Either when you depart from Chennai, before departure you file the voyage return, pay the tax. And if that is not possible for the master of the ship, then take permission from AO. They will authorize you to do the formality within 30 days after departure. And anyways, you people have agent in India. See, so that can be done. So this procedure you have to give. And what will be the answer for this? Period within which assessment thereof. Thereof means of the voyage return. Voyage return assessment is done within what period? 9 months. I told you, no? Voyage return assessment is done. Once the voyage returns are filed, all voyage returns assessment is done within 9 months from the end of the year when voyage return is filed. Okay. So this is the answer. So this question has come in past paper. So I have to answer fully theoretically. See, I have given the answer. Just see the red things. Means voyage return should be filed before the ship leaves. And if not possible, then within 30 days after departure it can be done, provided AO permits. And assessment should be done within 9 months from the end of the year when return is filed. You know, the word voyage return is not used by the law. They call this as return under section 172(3). By chance, if in the exam they say return under 172(3), it is a voyage return. See, one more good distinction. Voyage return is filed under 172(3). Main returns are filed under 139(1). Remember assessment procedure? So you can write a good distinction between what? Voyage return and main return. I will repeat last. What is the difference in voyage return? Multiple times return. Main return only one. Voyage return only Indian bookings at the time of each departure. But in main return, even if bookings are abroad, received in India, you have to take accrued or received in India, that concept. In voyage return, only PGBP reporting. Here all 5 heads. Here 35% tax. Here, according to the type of the slab rate, 35%, anything depending upon the type. Voyage return assessment are within 9 months from the end of the year when voyage return is filed. Main return assessment is done in regular assessment manner 12 months from the end of AY. Okay. Voyage return section is 172(3). Main return section is 139(1). Okay. So this completes what? This completes what? 172. Okay. Now what is remaining in this chapter, you know? Exemptions under section 10. This we will do in the next lecture. Plus you have to do some homework question also. Now in homework, all the remaining questions are homework. Because see, tomorrow my major lecture will go in homework discussion. Because all are good questions. And then from theory angle, I have to take this small theory of section 10. Rest everything we have done. And This section 10 oriented exemption, it doesn't have any questions in my book. So this is pure theory which I will take it in the next lecture. So whatever questions are remaining in the book, you have to do all in homework. All the questions remaining are homework. I am not giving the question number this or that. All remaining questions which are remaining till now is homework. And I will tell you first only, most important hero in your homework question will be what you know, question number 14. This is a master problem. Ditto same question has come in past paper. Ditto same. But in my question there are many points. I have made it as a master problem. But in exam only few points from this came. And this has come repeatedly in past paper. So question 14 will be the main hero in your homework questions. Okay. So revise and come. Please do the homework and come without fail. This homework is must, otherwise next lecture will be spoiled. Okay. Let me see, in case time doesn't permit, question 14 you should have tried. 14 and this 11th one. Sorry, not 12th one. These are the bare minimum question. See, I would advise you to do all sum before you see the discussion. But question 12 and 14 are the main attraction in this homework. Okay. Revise and come. Please do the homework and come.